Good evening, everyone. I just want to do a small customary check. Is my voice loud and clear? Can you see the screen? Can you see the video? Are we all set? A couple of yes in the chat box will do. All right, perfect. Thank you. Thank you, Ankur, Yashas, Jignesh, Vignesh, Prabhu. Thank you so much. We'll start in another 6 minutes at sharp at 8:30. Yeah. Thank you so much. Well, Rajendra, you have to check the voice at your end. It is maximum at my side. So anyone who cannot, the voice is low at your end, please check, because this is the maximum sound I have got in my system, right? You're welcome, Shrikant. Good to see you again. All right, perfect. Welcome, everyone. A very warm welcome to Mutual Funds Excellence Program. My name is Anupam Roomta, and I'll be taking your program for the next 3 days. In fact, till next Sunday, I'll talk more about that. And just to give you a brief about what we do, what I do. So I am a SEBI registered research analyst and a certified financial planner. I am into education, wherein I take programs on mutual funds, stocks, financial planning, and other investment related topics. Plus, I also have a stock research services. You can always go to my website later after the session, which is anupamroomta.com, and see, learn more about our work. Right. I'll not take much time on that. So let's begin with the session, with the program. I have a few things to clear out and some logistics to share, some very important things. So this timeline I'm sharing with you, this includes the 5 minutes break we will have in between. The break will be somewhere around 9:45 to 10 p.m., somewhere between that period, 5 minutes break. There will be Q&A in between. I'll talk more about that. And there will be quiz also about 5 to 7 minutes, right? So this timeline, for example, today we're starting on 24th of June, 8:32 p.m. to 11 p.m. includes all of this break, Q&A, and quiz time, right? It might extend a bit more if you have more questions, which way I'll take after the quiz in the end, but more or less will be done by 11 p.m. Same timing on 25th and 26th, next 3 days, same 8:30 p.m. Indian time. There are a lot of people from outside India, so I'm telling you this. So 8:30 p.m. to 11 p.m. And there is one bonus for all of you. Next Sunday, same time, 8:30 p.m. there will be only Q&A. No presentation, nothing. So basically, you will learn in this weekend. You will implement over the week. There is a WhatsApp group on which you can ask me hundreds of questions. There is no limit. I'll answer all your questions. Still, if you have questions and you want to come live and you want me to answer live, you have an option to come next Sunday and ask me questions live also. Now, this is something which we did not announce on the website, on any of the advertisements, on any email, nothing. This is a bonus which I'm announcing right now. Right now, before I go ahead, can you tell me in the chat box which all city or country you are from? Which city or country are you from? Mumbai, Qatar, Pune, Mumbai, Bangalore, Hyderabad, Bahrain, Chennai, Indore, UAE, Dubai, Pune, Belgaum, Canada, Sri Ganganagar, Rajasthan, Chennai, Saudi Arabia, Bahrain, Mumbai, Jaipur, Raipur, Bangalore, Kanyakumari. Perfect. I think the first person from Kanyakumari, at least that's what I have noticed so far. Dubai, UAE. All right, perfect. So we have people across the country and across the world as well. I believe few more people will join. Everyone has not joined so far. Anyway, let's move ahead. The next thing, the 3 secrets of mutual funds which you will take away from this program. The secret number 1, there's much more to the program apart from 3 secrets, but these are the core things I really want you to focus on, or you will be present to. You can ignore the risk parameters of mutual fund schemes while shortlisting. Now let me simplify. Have you heard of these terms called alpha ratio, beta, standard deviation, Sortino ratio, Sharpe ratio? Anyone? Yes, no, maybe. Have you heard of any of these terms? Alpha, beta, standard deviation, Sharpe ratio, or any of these terms? Okay. Those who are saying no, don't worry. The secret says you can ignore these terms. Now, I'm not saying they're not important, but the way we will create the framework and choose the schemes, we would take care of all these complex ratios in a very simple way, right? So you don't have to worry if you don't know this. The good news is you can ignore them, right? I'll talk more about this in tomorrow's session. Second, looking at past performance of a scheme beyond 10 years is meaningless. I will talk more about this in today's session, so I'll not elaborate it right now. Just keep this at the back of your mind. And the third secret is very few fund managers invest their own money in the funds which they manage. Now, this is changing because of the new SEBI law which came last year, but still the problem is quite serious and grave. And take it like this, for example, if you go to a cafeteria and the owner sits there all the time at the counter managing the show and managing the place, and you get to know one fine day, and that's your favorite restaurant or cafeteria, one fine day you get to know that the owner never eats there. Never. Now, wouldn't that make you a little uncomfortable? You know, maybe there is some hygiene issue in the kitchen or some issue for sure, which I as a customer do not know. Otherwise, when the owner is sitting there all day, why will he not eat anything in his own cafeteria? Right? The same thing is here. If the fund manager who is managing this day in, day out, that's his job. Every day, day in, day out, that's his full-time employment. He is doing research on the stocks and selecting a few stocks in which my money is going into. I mean, what is happening in mutual funds? Essentially, your money is going into stocks ultimately. You are investing in a mutual fund scheme, but that scheme is investing into stocks. And that's the research the fund manager is doing, right? Who is the fund manager, by the way? He is the topmost guy of your scheme. I'll talk more about the fund manager in the program. So now, if that manager who is doing this day in, day out, he or she is not investing his own money in the scheme, that will make me a little uncomfortable that, you know, maybe he's not confident in his own research, right? Otherwise, why will he not invest his own savings into that? I'm not saying everything should go there, but something should go there, some substantial should go there. So we'll discover this more in tomorrow's session, by the way. All right. Now, if you divide this program curriculum, you can say it comprises of starters, main course, and desserts. So today we will cover these 3 points. Even if you know nothing about mutual funds and stock market, you will come at par with everyone else. Whether you are a mutual fund advisor or distributor, by the way, in every batch, we have got mutual fund advisors. That's like the, you know, I can say the person who knows the best. And we have got people who know nothing about the market, right? With today's session, you will come at par with everyone else in terms of understanding the basics, right? At the same time, we will also cover tools to shortlist mutual fund schemes in today's session. And using these tools, tomorrow in the live session, again, I'll create a portfolio in front of you. Not exactly a portfolio, but I'll create a sheet in front of you where you will learn how to use these tools to finally come to a conclusion which schemes you want to invest into. It will be a live demo in front of you, right? Then we'll talk about creating your portfolio, how many schemes you should have, for example, right? How should you distribute between those schemes? That's covered in that. How do you monitor? You know, how frequently do you monitor and how do you monitor as a portfolio? When do you sell? Now, selecting is much easier, as you will realize in this program. The selling is a tougher part. When to sell is very, very important. It's more important than what to buy. Yeah, you'll discover that again. And of course, the taxation part. Then day 3. And this exercise working on sample portfolio is the cream of this program. So day 1, day 2, day 3, all 3 days are important. But day 3, this particular exercise, about 5 to 7 minutes, it's the cream of this program. Every concept which you will learn in these 2 days, you will implement in that 5 to 7 minutes and your concepts will be clear. Yep. Then we'll talk about some less known facts on mutual funds, how to choose an advisor and which platform to use. So this is a broad curriculum. By the way, for your information, there is no advanced course I have in when it comes to equity mutual funds. In this 599 rupees program, you will learn everything you need to know about equity mutual funds, right? So please concentrate, please focus, please attend live as far as possible, do the assignments. I'll come to the assignments later on, but make sure you are participating fully so that you can get complete value, because you will not need any course after this once you are done with this program. Yep. Now, Q&A, that's one last point before we go ahead. First of all, in today, somewhere in the afternoon, there was an email which came, which had a PDF documents called MFEP index. If you missed that, another email has come to you at 8:35 p.m., hardly 4 or 5 minutes back. Can you please open that email? Check your registered email ID and open that email. In that email, there is a attachment called MFEP index. This is the attachment. Please open it. I'll give you a few seconds. Everyone, please open it on your desktop or laptop, whatever you're using. Everyone has opened this. Now, this is index of mutual fund excellence program. What does it mean? Now, on day 1, especially, participants are usually very curious. You know, they have like hundreds of questions in their mind. What about this? What about that? And 99.99% of the time, that topic which they are asking the question about, that is covered in the program, right? Now, when you ask questions in the Q&A box, I end up reading these questions and telling you that this is already covered, which is a waste of time for everyone. That reduces the efficiency of the program and that reduces the value you will get out of it. So my request to you, for example, you get this question in your mind, what about international funds? Should I invest in it or not? So go to I. This is all in alphabetic order. International funds is there. It means if this topic is mentioned in the index, it means this topic will be covered before day 3 gets over. So please hold on, have patience. This is like a net practice of having patience, because in stock market and mutual fund, you need a lot of patience. So 2 दिन का patience तो हम रख ही सकते हैं, right? That simple patience practice we can do, right? Now let's say you have this question in mind: should I invest in NFO? Right? Go to the next page. There are 2 pages. Look at this NFO. It means NFO is covered. Let day 3 get over. Don't ask on day 2. अरे NFO तो cover ही नहीं किया. पर अभी day 3 खत्म ही नहीं हुआ ना. Day 3 is still left. Right? Then again, you might ask a question like, what about value funds? Should we invest in value funds? Again, value funds is mentioned here. Right? So anything which is mentioned in this index, please don't ask the question. In fact, the best way to participate in the program is to ask questions in the Q&A box relevant to first only equity mutual funds, right? And relevant to only the topic being discussed at that point in time. उस टॉपिक के ऊपर कुछ क्वेश्चन है, पूछो. नहीं है, इट्स गुड न्यूज, यू अंडरस्टूड द टॉपिक वेरी वेल, लेट्स मूव ऑन. डोंट जंप टू सम अदर टॉपिक, right? And this is only on equity mutual funds. There is so much to learn in this one topic. You will be amazed in the next 3 days, and you will be like completely confident when it comes to this one investment area, right? Just make sure you focus, right? And I'll take up questions in regular intervals. It will not be after every slide. After every few slides, a Q&A box will come, a Q&A slide will come, and then I'll take your questions, right? So you'll get to know in a while, right? As I said, ask questions relevant to only the topic being discussed. Now, very important, please look at this carefully. If I miss your question, number 1, it is not intentional. So this is batch 16, so I'm just talking from my experience. A lot of times when you ask questions, I tend to miss, not intentionally, but it happens. Now some people take it personally, like the other person asked the question long back, and just now you answered that. I have asked my question thrice, you're still not answering. So I have nothing against anyone here. So please don't take it personally, number 1. Number 2, ask again, right? If I still miss it, ask again in the end in the Q&A board, right? I might miss in the interim. So there is a Q&A in the end. Let's say there is a very, you're going through a bad day today, and your luck is not in your favor, and I don't just look at your question today for whatever reason, right? In that case, please ask in the WhatsApp group. Please understand, I'm there in the WhatsApp group till next Sunday. There is no chance that I will miss your question, right? So if I'm missing a question in the live session, please ask in the WhatsApp group. Don't worry, you will get every question answered in this next 8 to 9 days. Yeah, I hope you are with me so far. Can I get a few yes? Are you with me so far? No, Praful, we will not share the PPT. We will only share the recording. Yeah, with me so far. You're clear about the Q&A do's and don'ts. You're clear about the logistics of the program. You're clear about the timings and everything. Perfect. All right. Thank you so much. A couple of disclaimers. This program is only for education purpose. I will naturally talk about a lot of sectors and schemes in this program, but please don't take it as an advice to buy, sell, or hold. Now, please understand one very basic thing. Stock market or mutual funds has always been a minority game. Please listen carefully. It has always been a minority game, means majority of people lose money or make substandard returns. Substandard returns means returns less than FD, right? Now, if you want to fall in those minority, first of all, first thing you need to do, and it's not easy. The first thing you need to do is stop looking for tips. चाहे वो stocks है, चाहे mutual funds है, stop looking for tips, and it will not be easy. But at least you should know what you need to do. At least you should know कि किस direction में चलना है, right? So stop looking for that, because if looking for tips would have made would have made money for people, yeah, everyone would be rich in India by now. There is a lot of tips floating in the market, right? You are here to excel in something. You are here to learn something so that you gain confidence in yourself. So participate in this program from that perspective, not from the perspective of, oh, Anupam is talking good about this scheme, let me choose this scheme in my portfolio. Then what's the point of participating? Then you have your advisors, and you have your YouTube channels, and you have free media going on. You can always look for tips and invest. So not a big deal. So please don't stop looking for tips, at least for next 2.5 days, and then you will anyway not need tips after that, right? One last thing, you all know there's a quiz at the end of the session. It was mentioned in the website, it was mentioned in the email, mentioned in the WhatsApp group today. So every day, day 1, day 2, day 3, there will be a quiz on the learnings which you got on that particular day. And day 2 can have quiz on day 1 also and day 2 also, both. All the scores of top day 1, day 2, day 3 will be added for each participant, and the top 10 winners will get 600 rupees each in their bank account as cash. So you will basically recover your entire fees, right? Now, some of you might say, I am not here for 600 rupees cash. I'm here to learn. So I may not participate in the quiz. My request is participate in the quiz, not just for the cash prize. Forget about the cash prize. Forget about winning. Participate because it's a part of your program. It's a part of your learning. If you are not scoring well in the quiz, it's a reason you have got that you should revise your notes. Let's say you are making notes, or you should revise the recordings. So quiz is something you have paid for to be in this program. So please participate in the quiz. Having said that, if you are not in the live session and you're watching the recording later on, then you will not get access to the quiz. So quiz is you can say a facility to only those people who are taking out time and coming and attending live, who have aligned their timetable in a way that they're attending it live. Yeah, I hope this is clear. So please participate in the quiz. In the end, don't just leave saying that, oh, I don't want to participate in the quiz because I'm not here for winning cash prize of 600 rupees. I understand 600 rupees is not a big deal for any one of us, but please participate for the sake of learning, not for the sake of winning. I hope I'm clear on that. So let's start with the starters. Before that, just a second. Lokesh, I'm not sure if this is only you. Is there anyone else facing any video issues or audio issues? Is everything fine? Are we good to go? Are we all set? Yes, say yes if you are, if everything is perfect. Okay, it looks perfect for others. Lokesh, so can you please check your internet connection once? Okay, perfect. All right, so let's start with the first slide. SEBI categorization by market cap. Before we go ahead, let's understand this title first. So SEBI is Securities and Exchange Board of India. It's a regulatory authority for the financial market. The way we have RBI for banks, we have SEBI for financial markets, stock exchange, mutual fund, and everything. Now, what is market cap? It's a short form for market capitalization. That is the actual word. It is nothing but the size of the company. For example, market cap of Reliance is, let's say, 15 lakh crore rupees. It means if you want to buy the entire company, you have to pay 15 lakh crore rupees to Mukesh Ambani and all the other shareholders combined. So value of all the shares of the company, whether it is with the retail investor or with Mukesh Ambani, all the shares combined together, they are worth 15 lakh crore rupees. I'm just giving a vague number. It's somewhere close to that. I'm not sure exactly what's the number, but that defines the market cap or the size of the company, right? Now, SEBI has categorized the companies or the stocks as per their size, as per their market cap. What have they done? So this is what they've done. Let's say you arrange the companies in descending order. Number one company, Reliance, then TCS and SDFC and so on. In a descending order, the biggest company, then the second biggest and third biggest. The top 100 companies are called large cap. Large size, large capitalization companies, right? The next 150 companies, 101st rank to 250th rank, are called mid-size companies or mid-cap companies, right? And the remaining 251st onwards till 5,000 plus companies in the country are all categorized as small cap or small size companies. Simple, right? Now, why is this happening? Why are they doing this categorization? Because when you invest in mutual funds, they are defined by these categories. Is it a large cap mutual fund scheme? Is it a mid cap mutual fund scheme? Or is it a small cap mutual fund scheme? Right? So as an investor, I should know that where exactly is my money going? Is it going in all the big companies? Is it going in the mid-sized companies? Is it going in the small-sized companies? Or is it going in the mixture of any two of them or all three of them? There are all kinds of different categories, but this will define and it will make it more transparent for the investor that where is the money going, right? I hope this is clear. Now, next, whether you call it fund or you call it scheme, you call it mutual fund scheme or mutual fund, they are just same things for the different names for the same things. Everyone uses the terms as per their own wish. So I can say, which fund are you investing into, or which mutual fund scheme are you investing into, or which scheme you're investing into. They are one and the same. So don't get confused. Number one. Number two, AMC or asset management company is nothing but the fund house, which is nothing but the mutual fund company. Again, fund house or AMC sounds like a technical term. It is nothing but, let's say, SDFC mutual fund. You can call it a mutual fund company, you can call it a fund house, or you can call it an AMC. right? It's the same thing. So we have 40 plus AMCs in India. I think 45 plus now, or 45 AMCs in India. Example, ICICI Prudential Mutual Fund, SDFC Mutual Fund, Aditya Birla Sun Life Mutual Fund, SBI Mutual Fund, L&T Mutual Fund, and so on. Right? So these are all called AMCs. So I'm telling you these terms because I will use them frequently without explaining further in the program. I might say which AMC is this. So AMC means asset management company, or which fund house is this, which means which mutual fund company, right? Next, benchmark or index. Now you might have heard of these terms, Sensex, Nifty, or Nifty 50. It's the same thing. You call it Nifty or Nifty 50, it's the same thing. Or Nifty 100, Nifty Next 50, banking index, infra index, tech index, pharma index, right? What exactly are these? Now, to give you a couple of examples before explaining, let's understand why do we need benchmark. So let's take an example of a classroom. Let's say there's a class of 50 students. Class teacher says, I want to form an index of top 10 students, and the index will be called top 10 index. Now in every examination, whatever is their percentage marks, I will take an average of those top 10 students and display on the board. Let's say it is 87%, right? The next examination happens, the average becomes 84%, right? The next examination happens, it becomes 82%. So now the teacher knows that the performance is going down. So this will help the teacher to know what exactly is the reason. They can, they can analyze whether it is the fact that students are not able to perform because of some lack in the teaching, or maybe the question paper is tough, or what is exactly is the problem happening here, right? So that index is helping the teacher to analyze the performance of students. Let's say another class teacher comes. She says, I want to form an index called mathematics index, and I want to see the average of math score for an entire class in every examination. Same concept. The figures will be displayed on the notice board. Another teacher comes. She says, I want to form an index called left-handy index. So all the students who write with left hand, I want to see which subjects are they performing better. So I can have left hand geography index, left hand mathematics index, left hand English index. So I want to see which subjects are they performing better. Maybe because of their left hand style, their analytical abilities are different from other students. So that could be one thing. One last example. One more teacher comes and she says, I want to form a sports index. So there are 8 students in the class who are active in different sports: volleyball, soccer, cricket, chess, whatever it could be, indoor and outdoor. The class teacher wants to see how are these 8 students performing on an average, because they are more interested in sports, or they are more active and more, higher performing students in sports. I want to see how are they performing in the particular subject, or maybe overall, right? Now, bring this to stock market. There are 2 class teachers in India, NSE and BSE, National Stock Exchange and Bombay Stock Exchange. Now they have their complete freedom what index they want to form. So one day BSE came, Bombay Stock Exchange came and said, I want to form an index called Sensex. In this Sensex index, I will take the stock price of top 30 companies of India by size, top 30 biggest companies of India, and I will display the number. There is some back-end calculation. Don't worry about that. That back-end calculation is not important. What's important is how is that Sensex moving over a period of time. If it is going from 40,000 to 50,000, it means on an average, the stock price of these 30 companies has gone up by 25%. From 40 to 50 is how much? 25% increment, right? NSE came, NSE said, I want to form an index called Nifty 50, in which I will take top 50 companies by size, not top 30. And I'll display the score, display the Nifty index every day, every moment when the market is on. Right? Similarly, you have Nifty 100. What is Nifty 100? The name is telling you all the top 100 stocks, basically all the large cap stocks, right? Because top 100 stocks are called large cap stocks. What is Nifty Next 50? Again, think. The name is telling you the answer. Nifty 50 is top 50. Nifty Next 50 is 51st rank to 100th rank stocks. Right? Now coming to Nifty Banking or BSE Banking or Nifty Banking, what will it have? All the banking stocks put together, how are they performing on an average over a period of time? Same with Nifty Auto, Nifty Pharma, and so on. Right? Now let's take an example. So first you understood why do we need benchmark? We need it for grouping, for analysis purpose. Right? Now let's say I go to this one article. I'll just read the headline of this article and I ask you a question. So just read this carefully and I'll ask you what exactly it means? So first of all, look at the date. The date is October 2020, right? So we were 6 months into this COVID and lockdown from 1st April, if you assume, till 30th September, 6 months had gone. Now the headline was Nifty Auto surpasses Pharma Index to outperform the benchmarks in last 6 months. It is saying the Nifty Auto Index, that basically all the automobile stocks put together, their stock price has done better on an average compared to all the stock prices of pharma companies. That is the pharma index. Now, tell me in the chat box, why is this a news? Think and tell me why did this become a news? ये इतनी बड़ी news क्यों है? Everyone, please think and answer. You have to participate. As an investor, as a learner, you have to think. Perfect. COVID pharma should have performed better. Auto sector was shut. More purchase of medicine. Auto shouldn't have performed. Yes. Yes. Exactly. Perfect. So see, it's a very simple common sense logic. In the COVID, unfortunately, people were losing their job, their business income, right? The economy was in one of the worst conditions ever. So people who had booked cars, they were canceling their cars. New people were not coming and booking the cars. So the auto sales was at its lowest point. Still, auto stocks performed better than the pharma stocks, and pharma was something which everyone was talking about because everything was about health in those, at least in those initial period. Right? So it is a surprise that, auto stocks have done better than pharma stocks. Now, don't get into कि ऐसा क्यों हुआ, because in the short term, market can be as irrational as you can expect. This does not make sense fundamentally, but in the short term, market behaves in a very erratic way. In the long term, it follows the fundamental. In the short term, it can be exactly opposite of the fundamental, right? But you understood the news headline now. It is telling you that Nifty Auto Index has done better than Pharma Index, which is quite surprising, right? That's why this headline is there, right? So basically, you are able to compare different indices also. Banking compared to IT, compared to infra, compared to pharma, compared to automobile. You can compare how different industries are doing, right? In terms of stock prices of those companies, right? Second thing, last point in this. Let's assume there is no index or no indices available in the market. Sensex, Nifty, banking, कुछ भी नहीं आता, कोई news पे कुछ भी नहीं आता ऐसा. You just get stock prices. Monday morning, you want to see where is the market heading. How will you check? You'll open your screen, your mobile app maybe. You will see, okay, Reliance is going here, SDFC Limited is going there, Eicher Motors is here, Airtel is here, SBI is here. I mean, you will not be able to make out what is the overall direction of the market. Where are the top 30 stocks going? Where are the top 50 stocks going? Where is banking going? Where is IT going? Where is pharma going? Right? You'll be totally clueless. You have to do that manually. That, this is a set of 20, 30, 40, 50 stocks. This is how they have performed. 10 stocks have gone up, 20 stocks have gone down. So average year return. Right? So now you understand this is the significance of having a benchmark or an index. Yeah. Now let's move forward. Why I was talking about all this? Because every mutual fund scheme has got a benchmark. What does it mean? I am investing in an ABC mutual fund scheme. How do I know where my money is going? That benchmark will define. Let's say the benchmark of a ABC mutual fund scheme is Sensex. It means the fund manager, who is the topmost guy, he is doing research on those 30 stocks, taking out, let's say 20, 22, 25 stocks out of them, which is good as per him compared to all the 30 stocks, and investing in them. So I know my money is going in the Sensex stocks, not all the 30 stocks, but some of them, right? Another scheme is XYZ mutual fund scheme. The benchmark is Nifty 100. It means the number of stocks in that scheme is, let's say, 35. So out of 100 stocks in Nifty 100 or top 100 stocks, the fund manager, as per his research, has chosen 35 stocks, which he believes are better than investing in all the 100 stocks put together. So that benchmark is telling me in which direction my money is going. It's going in the mid cap, small cap, large cap, banking, pharma. Where is it going? So that benchmark is very important for me to check as an investor. Yep. Got it? Perfect. Next, Total return index. Now, everyone, whenever you have a question, don't write in the chat box because I will definitely miss that. You have to write your questions in the Q&A box. And as I said in the beginning, ask questions relevant only to what we are discussing. कुछ भी नया topic दिमाग में आता है, पहले MFEP index देखो. If that topic is mentioned there, don't ask that question. Right? It will be a waste of time for everyone. Now, total return index versus price return index. Let me ask you all a question. Let's say Sensex went from 40,000 to 50,000, which now you understood means the 30 stocks of Sensex, their stock price has moved from 40,000 to 50,000 on an average. It has gone up by 25%, right? Forget about the back-end calculation. Whatever the calculation is, average appreciation in the stock price of those 30 stocks is 25%, right? Now, you know, there are some companies which give dividends. Some companies do not give dividends. Some companies give dividends, right? That dividend comes to your bank account when you're investing directly in the stocks. In case of mutual funds, that scheme is investing in those stocks and that dividend is coming to the scheme. And that dividend belongs to you and me, we as investors, but it is coming to the scheme, then fund manager can use that money to further invest that money, right? Now, when we look at the Sensex, it is moving from 40,000 to 50,000. Is it also including the appreciation because of dividend? Yes or no? Think and tell me. When you see that Sensex has moved up from 40,000 to 50,000 or 50,000 to 60,000, is it only incorporating the price of the stocks or is it also incorporating the dividend which those stocks have given? No, right? That dividend is not being taken into account. So this, when you look at the simple Sensex or Nifty, it is called price return index. It is telling you stock price mein kya return aaya, uska index hai, right? Now, what is total return index? It basically includes returns made by reinvesting the dividend income. So it is assumed that whatever dividend came to that scheme, the fund manager used that money to invest further in other stocks or whichever stocks he wants to invest into, which is obviously happening. This is natural. Every fund manager will do that. But till hardly 3 years back, this was not happening. The benchmark was always price return index. So when I was comparing the performance of my mutual fund scheme, I was comparing it to the price return index, not to total return index, which is not an apple to apple comparison. It was an undue advantage to the fund manager or to the scheme or to the mutual fund company. It was not a proper comparison because they were getting some dividend income, which was, let's say, 2% of the total returns, which is 2% is quite significant. They were able to perform better than the benchmark. Why? Because the dividend was also coming in and they were investing that money. So SEBI intervened. They said now to make it more transparent and to make it more apple to apple comparison, all the indices which will be set as benchmark will be total return index. They will not be price return index. Example, so whenever you look at a benchmark of your scheme, every scheme has got a benchmark, as I said, that it will say BSE Sensex TRI, Nifty 50 TRI, Nifty 100 TRI, BSE 150 mid cap TRI. So when you see the word TRI, it simply means they have taken into account the dividend component also, right? For example, if I click on this one scheme, let's look at the name of the scheme first. The name of the scheme is ICICI Prudential Sensex Index Fund. If I go down, look at on the right hand side, S&P BSE Sensex TRI. Right now, that's all TRI means. Now, in case you have not understood TRI concept, let me give you a good news. Don't worry at all that it does not make any difference to your research. It does not make any difference to your returns in the future. Only thing you need to understand is TRI was, it came up from SEBI and it's a good thing for the investor. It's a good thing for you. That's all you need to understand, right? The reason I'm explaining it here is because you will look at this term TRI, you should know what it means. It simply means it's good for you. Yeah, let's move on. Net asset value, NAV. Now, NAV is nothing like a stock. It's like a stock price of the company. When you see Reliance का stock price क्या है, similarly mutual fund का stock price क्या है, mutual fund की unit जो है उसका price क्या है, that's called NAV, right? So NAV is a price at which you buy units from the fund house or sell it back to them. So when you are buying mutual fund schemes, the money is going to them and units are coming to your account. When you are selling mutual fund schemes, it is going back to that fund house or to that mutual fund company and they're giving you the money, right? So it's a price at which you can buy and sell the units from the fund house. Now, this is reported daily after market closes. Now, this is not like a stock price every second. They will not tell you the NAV. No, that's not available. for example, Reliance or Eicher Motors or Airtel or whatever the company is, whenever the market is on, it's open, you can see the stock price moving up and down every second. That is not the case with NAV. Now in a mutual fund, there are like 50, 60, 70, 80 stocks. When the market closes by at 3:30, after that, the calculation is done. And then they declare the NAV of the scheme today is this based on the composition of the scheme, right? So it is declared after a few hours of market closing, right? Now let's watch a video. I'm playing a video. Watch that and then I'll explain further. Very interesting video.
So you want to buy mutual fund units. Should you purchase one with a low net asset value or a high net asset value? Let's assume you have two options, one mutual fund with an NAV of rupees 10 and one with NAV rupees 50. Just because a net asset value is lower doesn't mean buying into the fund is cheaper or better. Let's say you have 10,000 rupees to invest in each fund. A 10% investment in a company that itself goes up by 5% would result in both funds, NAV 10 and NAV 50, to go up by 10.5%. Therefore, 10,000 rupees invested into both of these funds would become 11,050 rupees. One reason why a scheme's NAV is high is because it was launched many months or years back. A scheme that has been around for years would have bought and sold shares for many companies till date, and hence its NAV has risen. A new scheme would have just launched recently, and hence its NAV would be 10 rupees or closer to 10 rupees. So, what's the verdict? The actual NAV of a mutual fund scheme doesn't matter. The quality of the fund and the returns you'll get are what matter. Things like the fund's underlying companies, where your fund managers have invested in, and their rationale for the same are most important. Thankfully, fund houses no longer advertise 10 rupee NAVs as a peg to lure customers as they used to.
So the most interesting line was the fund managers or the schemes or the sales representative do not, say that rupees 10 NAV scheme is better, though it is still happening. This mis-selling is still happening. The bottom line of this video was NAV of a scheme does not make any difference to the kind of returns you will make in future. So this is what people do in stocks also. Ye 10 rupees ka stock hai, this is cheap. This will give me better returns. This is 2,000 rupees stock. Why will I invest in 2,000 rupees stock? So expensive. How much money can I make? Right? 10 rupees stock, I can make money. It is a flawed thought process there also. It's a flawed thought process in mutual fund also. Let's say there are two schemes, scheme A, scheme B. Scheme A has got a NAV of 10 rupees. Scheme B has got a NAV of 300 rupees, right? Let's assume both of them have got same stocks, because where is the money going in mutual funds? The mutual fund money is going into stocks. So managers of both the schemes have chosen the same 50 stocks in the same proportion. Same stocks hai dono ke andar, but ek ki NAV 10 hai, ek ki NAV 300 hai. It is possible because one scheme was launched long back and it was just growing, right? Now, if the 10 rupees NAV schemes becomes 20 rupees, even the 300 rupees NAV will become 600 rupees. Why? Because the composition is same. It doesn't matter what is NAV. In fact, the NAV, let's say the composition is different. There are two different schemes, different stocks. So NAV 10 can become NAV 5. Why? Because the stocks did not perform. NAV 300 can become NAV 600 because the stocks performed. So if you have been looking at the NAV of a scheme to select the scheme so far, please stop doing it now. Now you're getting yourself trained into this. Now NAV has no significance. If you still look at NAV of a scheme in future to choose your mutual fund scheme, it is pure stupidity. It is pure stupidity to look at NAV of a scheme. I hope it is clear to all of you. Yeah. All right. Next. Now, there are different types of mutual funds based on different themes. For example, based on scheme, there can be an open-ended scheme, which you can buy and sell on any working day. So it's called an open-ended scheme, right? There's another scheme called close-ended scheme, wherein it issues fixed number of units and there is a lock-in period. You can buy those, let's say there are, X number of units. They open the window, the scheme is open from X date to Y date. You go and buy the units, whatever you want to buy. A lot of investors buy that. Once those units are sold, the scheme closes, and you as an investor cannot sell your scheme also. It is a lock-in period of 1, 2, 3, whatever number of years is it. That's why it's called closed-ended scheme, right? So typically, they are also traded in the market. That is like a stocks you can also buy and sell in the stock market, but it is illiquid. Illiquid means there are very few buyers available. I mean, ask yourself, how many times have you gone to your demat account and purchased a mutual fund scheme? Hardly, or maybe none, right? So it's very illiquid because not many buyers are there. They are looking for mutual fund schemes on the stock market, right? Having said that, how do you identify such schemes? One way to identify is the name of the scheme will have the word series. It means it's a closed-ended scheme, right? And having said that, even under the scheme details, it will say closed-ended scheme or open-ended scheme, so you don't have to worry about that. Now, the third category is called interval scheme. Now, in this, it opens at a specified period. It is also like a closed-ended scheme, but it opens more frequently. Let's say every 6 months, the window will open. In that window, in that few days, you can buy and sell units. You can, let's say you purchase 1 year back or 6 months back. After 6 months, the window opens again. You want to sell your units, you can sell. You want to buy more, you can buy. But again, it closes for another few months or few years, and then again it opens. So it's like an interval in which they are opening and closing. Now, again, they will have the word series in their name. So if the word series is there in the name of a scheme, it is either closed-ended scheme or it is an interval scheme, right? Now, if you look at most of the schemes we are talking about, when you look at a TV channel or maybe any news article or anyone you're discussing with, most likely they're talking about an open-ended scheme, most likely, right? And my suggestion to you would be to stay away from closed-ended and interval schemes. Or invest only in open-ended scheme. There are simple reasons for that. Number one, if you look at the performance of closed-ended schemes and interval schemes, they have performed much lower compared to open-ended schemes. So number one reason is I am investing for higher returns. Why will I invest in closed-ended schemes, block my money, and also make less returns? I am saying on an average. I'm not saying every scheme, right? And second thing, please understand. I mean, as I already said, there is no point blocking my money. I'm not saying I want to sell and buy frequently, but I should at least have the flexibility to do that, right? Maybe there's some emergency and I need money. I should be able to sell it, right? Or I believe there's some fundamental problem with the scheme. I should be able to sell it. I want to invest for long term. I want to stay invested for long term, but I also want flexibility, right? So when I'm getting flexibility and higher returns, why will I go with closed-ended and interval schemes? Right? So my suggestion will be to ignore these two categories, focus only on open-ended schemes. And there are hundreds of schemes available within the open-ended schemes. You don't have to worry about missing out anything or losing any opportunity. Yeah. Next, based on fund management, the way management is done. One is called passive scheme. It follows a market index. You can also call it index funds. It's called passive investing or investing in index fund. For example, let's say this scheme is called ICICI Prudential Sensex Index Fund. Now look at the name of the scheme. That itself is giving you the answer. It is ICICI Prudential is the name of the company, mutual fund company, Sensex Index Fund. So this is a mutual fund scheme which is investing in the index called Sensex. What does it mean? It simply means the fund manager is investing in those 30 stocks, all the 30 stocks which comes in the index called Sensex. Fund manager is not supposed to use his or her brain. They are just supposed to copy paste. Anyone can become a fund manager. Fund manager is actually only for the namesake for an index fund. They have no role to play. Their job is to ensure that copy paste is happening properly. So any index fund, whichever index they are following, Sensex index or Nifty index or Nifty 100 index, they are simply copy pasting the stocks which are there in that index. Now, can these stocks change? Yes, they can change. Now, top 30 index, let's say 4 stocks move out because of whatever the criteria is, size, and there are other criteria also. The main criteria is size. Let's say 4 stocks move out of Sensex and 4 other stocks move in Sensex. It will always have 30. So if 4 are moving out, 4 will come in. What will fund manager do? They will sell those 4 stocks in the scheme and buy the new 4 stocks. Simple. Copy paste. They are supposed to copy paste. Dimag nahi lagana hai. They're not allowed to use their brain. Right? That's why it's called passive investing or investing in index funds. Right? Next category is active investments, where the fund manager actively picks stocks based on research, right? And that's they claim, or they at least want to prove that they can give better returns than investing in index funds. Right now, charges are much higher in active scheme compared to passive schemes. I'll talk about the charges in today's session. Then you'll get to know it better. And that's why they're charging you more, because they are claiming that they can give you higher returns. Whether they will give higher returns or not, that time will tell. But at least they are claiming that, and on the basis of that claim, they're taking more charges from you. Yeah, we'll talk about whether you should invest in index funds and in which category. All that will come in the program, so don't worry about that. Right. So basically, fund manager, FM is what fund manager is saying, that instead of investing in the index fund, invest with me, I will give you higher returns. Right. So let's go to one scheme. Let's look at a couple of things. So name of the scheme is Access Blue Chip Fund. Right. First thing, let's look at what is the benchmark of the scheme. Go down. Look at the right hand side. BSE 100. Benchmark is BSE 100. It means top 100 or all the large cap stocks are the benchmark. So fund manager is supposed to research on those 100 stocks and pick some good stocks from there, because it's an actively managed scheme, right? Let's go down and see number of stocks. 40. So out of 100 stocks, based on the research and the skill, fund manager has chosen 40 stocks. As of now, this scheme has got 40 stocks in which the investor's money is getting invested into. And they are claiming that they will give you better returns. Instead of you going and investing in BSE 100 index fund, you can invest in this scheme. This will give you better returns. Yeah, I hope this is clear. So there are two ways to invest. One is passive, one is active. So you have a choice as an investor where you want to invest, and we'll discover this in this program. Now, based on types of plans, growth plan. What is growth plan? Only capital gains. What is capital gain? Your money grows from 100 to 110 to 120 to 130. That's called capital gain. Capital is what? Money gain, right? Only money gain is there. There's another plan called dividend plan, or it's also called IDCW, income distribution cum withdrawal. Technical name is simple plan and dividend plan. Now what happens in this? You gain in the form of dividends and capital gains both, right? Now don't assume, don't get the notion that this is the better scheme. Why? Because you're getting dividends also and getting capital gains also. The money is coming from your pocket only. Let me explain. Let's say the NAV of a scheme is 100 rupees, and the scheme declares dividend for all the investors at rupees 2 per unit. It means, let's say I have got 100 units of a particular scheme, and 2 rupees per unit is the dividend I'm supposed to get in my bank account. To 2 rupees multiplied by 100 units which I have got, that is 200 rupees. 200 rupees will come to my bank account, right? But the moment that happens, the NAV of the scheme will drop from 100 rupees to 98 rupees. Why? Because the money is coming from your own pocket. कोई free का पैसा नहीं मिल रहा है कहीं. There are no free lunches. They are just giving you money from your own pocket. They are withdrawing that to 2 rupees per share. They are per unit. They are selling some shares, getting some cash, and giving you in your bank account. Now, why will you invest in this scheme? Because you want regular income, right? So whether you want regular income or not, that depends on whether you go for a growth plan or a dividend plan, right? I'll talk more about that in terms of taxation, but let's move on for now. Please note that dividends are not fixed or guaranteed. Guaranteed as in you can't say that, I will get this much of dividend for sure, because this is what dividend they have paid in the past. They will pay dividends regularly for sure, but their amount is not fixed or guaranteed, right? Now, whether you should choose a growth plan or a dividend plan, that depends on your taxation, which I will cover on day 3. So hold on to that question. If you have this question, should I invest in growth plan or dividend plan? Hold on to that question. That will get answered on day 3 for sure. Day after tomorrow, right? Now, Q&A. Just a second. Let me start the timer of 4 minutes and let me look at the Q&A box. I'm looking at the Q&A box. I'm not looking at chat. So if you have posted a question in chat, please write it in the Q&A box. Praful, I think your question is answered now. If the companies are moving out of Sensex or Nifty and new companies are getting into it, so it will, it will change. Companies do move in and out, but it is very rare. It's not something which is happening every day, every month, or every year. It happens very rarely because there are other parameters also. Apart from size, there are some few other parameters also. Does NAV always start at 10? Typically, yes, Nitin. Yes, they start at 10 NAV. They just represent it with the number 10. Now, the point is, वो 10 grow कितना कर रहा है वो important है. 10 is going to 20 and 200 is going to 600, then 200 wala scheme is better. because their stocks have performed better, right? So NAV in itself has no significance at all. Does NAV matter when it comes to dividend payout? No, it does not. Doesn't make a difference. NAV का कोई value नहीं है. NAV is something you should not even think about whether you are buying or selling a scheme in terms of returns किसमें ज़्यादा आएंगे कम आएंगे. All that doesn't make a difference. Why does NAV rise with the age of scheme? How does number of years of scheme has been trading changes NAV? Simple है Ketan, see, understand. I started a scheme 10 years back. उसकी NAV 10 मैंने define कर दी. Now वो जो stocks लिए थे वो change भी हो रहे हैं. But market has in general has gone up. So market has that those stocks in which they invested, the stock value has gone to double. So NAV will also go from 10 to 20, then 40, then 100, then 200. Every scheme will not go from 10 to 200. Some scheme will go from 10 to 50. Some will go from 10 to 200. Some will go from 10 to 500. That depends on the performance of the scheme, right? So it doesn't matter what is the NAV of the scheme today. What matters is the growth in that scheme. When it's index fund, does fund manager have option to decide what percentage to invest in which stock in that index, or they have to invest only according to weightage in index? Very good question. They have to invest as per the weightage in the index. They can't decide anything in terms of they cannot do anything. उनको कुछ नहीं कर सकते, उनको सिर्फ copy paste करना है. I have seen that some people are getting exact same amount of dividend on the mutual fund investment every month. How? If dividends depends upon NAV. So that depends on the decision of the fund manager. They have taken a decision कि हमें हर महीने या हर दूसरे महीने fixed dividend देना है. Whatever is the NAV, they can always decide, change the number accordingly, जिससे कि same amount investor के account में जाए. So that's a call, active call the fund manager has taken. Any way to evaluate mutual fund like stocks? You're talking about valuation like PE, PB? No, there's nothing. That is not something we do that for. You'll get to know in this program completely, but that's something you don't have to look at. Karthikeyan, regarding mutual fund distributor, you have to Google search or maybe ask people around you. This is like out of syllabus question. I am not the best person for this. Google will give you the answer very easily. Don't worry. How frequently does the fund manager reshuffle the stocks in a scheme? Kaushik, this is covered in the program. No issue, Sachin. I got there was some technical issue. Where to see the charts of mutual fund from initiation? We'll cover that, Shrikant. You can look at the returns of the scheme. 10 years, 5 years, all that is available. Dividend to company de rahi hai, then why to sell shares? I didn't get your question. You have to rephrase it. NAV 10 will always be like at NA4 time, right? Yeah, most likely Preeti, yes. I think I answered this for someone else as well. Can index fund from different AMC offer different returns? No, Sachin. The only difference will be in terms of the expense ratio. You will get to know this answer more clearly tomorrow. But more or less, the difference will be very close. HDFC का Sensex fund है, L&T का Sensex fund है, दोनों के रिटर्न सेम आएंगे. 0.1, 0.15, 12 का डिफरेंस इधर उधर हो सकता है, कभी कोई ऊपर कभी कोई नीचे. उसका रीजन भी we'll get to know tomorrow. One last question. Hold on to my questions. One last question, then I'll move on to the next slide. If same stocks are available on different NAV, it would matter, right? Because I would choose less NAV one and will use the remaining money to find other scheme. So Praveen, नहीं समझ, आप समझे नहीं. Low NAV का लेकर क्या होगा? You will get more units. That's again the concept people have in misconception people have in stocks. कि मैं सस्ता stock लूंगा तो units ज़्यादा आएंगे. अरे units का क्या करना है? It's not number of units or number of stocks is not important. The return is important. It's like someone buys 50,000 worth of gold. इतना सा आएगा. And someone buying 50,000 worth of let's say steel. So the person who is buying steel will be happy. Oh, look, I've got such heavy steel. You've got such a small gold. Stupidity, right? Think about it. It's about the value which is there inside that product. It's not about the quantity or the size or the heaviness of the product. तो NAV चाहे किसी की 10 है, एक की 500 है, दोनों में अगर सेम स्टॉक्स हैं तो 10 वाला भी 50 पे 20 पे पहुंचेगा, 500 वाला भी 1000 पे पहुंचेगा. आपको 10 लेके ज्यादा मजा आ रहा है, कर लो, but that will not give you more returns. That's what I'm trying to say. Right? Okay, let's move on. Hold on to your questions. Let's move to the main course. We'll look at the tools to shortlist mutual funds today, and the remaining things we'll cover tomorrow. First tool, or first parameter is portfolio turnover ratio. So the definition of portfolio turnover ratio is the percentage of mutual fund schemes portfolio that has changed in a year. Don't worry, नहीं समझ में आया? We'll take an example. Simple, बहुत simple है. Let's go to the scheme called SGFC Top 100 Fund. By the way, जो मैंने NAV के example दिया, NAV 10 and NAV 500, the same stocks are there in the both the schemes. That's a hypothetical example to explain the concept why NAV is not important. Typically, ऐसा कभी होता नहीं है that two schemes have got exactly same stocks in the same proportion, unless they are index fund. Index fund तब तो वैसे ही फर्क नहीं पड़ता, right? Otherwise, it doesn't happen. But the idea, the message I want to convey is कि NAV is irrelevant, right? All right. So look at this. Turnover ratio of the scheme is 13.78%. What does it mean? It simply means in last 1 year, listen carefully, not 1 month, not 1 quarter, not 6 months. In last 1 year, this fund manager has sold 13.78% worth of stocks in this scheme and bought something else. For example, total size of this scheme was 100 crore. 100 crore rupees was invested in different stocks, right? So in last 1 year, this fund manager has sold stocks worth 13.78 crores out of 100 crores and bought some other stocks. Why did he do so? Because his research said sell these stocks and buy something else. That's what his job is, right? To do the research day in, day out and choose fundamentally sound companies and invest in them, right? So this is a turnover ratio. Turnover means how much churning you have done in the stocks in terms of the value. This is not 13.78 percentage of number of stocks. This is 13.78% of the value of the stocks, value of the scheme. Total fund size का 13.78%, right? एक example और लेते हैं. Nippon India Growth Fund. Let's look at the turnover ratio for this one. 86%. It means in last 1 year, this fund manager has sold 86% of the portfolio and bought some new stocks. Right? Now, question to all of you. Tell me in the chat box. Can a fund has more than 100% of turnover ratio? Yes or no? Think. Don't jump on to answer first. कोई prize नहीं मिलेगा. Think. Can a fund have more than 100% turnover ratio? सोच कर जवाब देना. जल्दी आंसर करने से कोई प्राइज नहीं मिलना है. Yes, no, maybe a lot of people are saying yes, some people are saying no. Okay, so answer is yes. A fund can have more than 100% turnover ratio. How? In first 10 months, जैसे आज से शुरू करते हैं. In next 10 months, the fund manager sold every stock or 100% of the scheme and bought something else. अभी भी 2 महीने बचे. To complete 1 year, 2 months are still left. He sold 20% stocks more in those next 2 months and bought something else. So the turnover ratio of this scheme will be 120%. It's possible. It is possible to have more than 100% turnover ratio. Don't be surprised. Right? Now, question to you. Do you want your scheme to have a high turnover ratio or low turnover ratio? Again, think before answering. Jaldi mein answer nahi karna hai. Think. Do you want your scheme to have a high turnover ratio or low turnover ratio? Everyone, please participate. High turnover ratio, low, medium, low, high. Medium को छोड़ो, low या high बताओ. There is no answer to what is low, high specifically, but general conception point of view say it should be high or low. Okay. Those who are saying high, okay, hold on everyone. Hold on to the answer. Let me ask you next question. Those who are saying they want high turnover ratio, let me ask you one more question. This question is only for people who have said high. Do you want your hard-earned money to be managed by a trader or investor? You want the fund manager to be a trader or investor for your hard-earned money? Answer. You want a trader to manage your hard-earned money or investor to manage your hard-earned money? Investor, right? Now, please think about it. The point here is high turnover ratio reflects lack of conviction of the fund manager. They are supposed to do research in a very thorough manner. अगर कोई stock आज लिया, after a few days and few weeks they want to sell, that shows that what kind of research they did few days back. What's the point? Trading ही करनी है तो I can also do it directly in the stock market. I am looking at a fund manager who who has confidence in what he or she is doing. He knows his research. He knows what he is doing. That shows lack of conviction, number one. Number two, please understand the way when you buy and sell stocks in your Demat account, you have to pay some Demat charges, transaction charges. Similarly, mutual funds also have to pay that, right? So that leads to high charges, and that charges are paid by who? By you and me. Whatever is the cost of running a fund house, be it employee cost or be it operations, office operations and marketing and all these transaction charges, everything goes to the customer ultimately. I'll talk about expense ratio in a while. But if there's more churning happening, if the turnover ratio of a scheme is high, you will notice that even the charges of that scheme is high, which is again not in my favor, right? So I prefer a low turnover ratio, but listen carefully, but it is not to be looked in isolation. So I'm not saying a 20 turnover ratio scheme is better than a 50 turnover ratio scheme. I want it to be low, but this is not the only parameter I'm looking at to select or reject a scheme. There are other things also to be looked at, right? I may invest in a 50 turnover ratio scheme. Why? Because all the other parameters which we will learn in this program are much better in a much balanced way. So in fact, any parameter for that matter is not important in isolation, except one. I'll talk about that. But when it comes to turnover ratio, I want it to be low, but don't judge a scheme based on only one thing. I hope this concept is clear, right? Now, before we move on, I want to take a few polls. Let me launch them. You can see 3 polls in front of you. Just want to see the kind of audience we have got. So number one question is, do you invest in mutual funds currently? Yes or no? Number 2 question is, which age group do you fall into? And number 3 is, since when are you investing? So if your answer is you're not investing in mutual funds right now, click on not applicable, NA. Others can answer, since when are you investing in mutual funds specifically, not stocks. Just to see what mix of audience we have got in this batch. Few seconds more, everyone please answer. 3 questions are there in front of you. Answer the question and then submit so that your poll is submitted. 5 seconds more. All right. Okay. So around 70, you can see the results in front of you. 77%, let's say 3/4 of this audience here are already investing in mutual funds. Remaining are yet to start. When it comes to age group, 31 to 40 are the maximum, followed by 41 to 55, then 20 to 30, and there are a few people above 55 as well. A really warm welcome to you because you are willing to learn at whatever age you are at. So that's commendable. Okay, this is interesting. There are people with all sorts of experiences, less than 1 year to 1 to 3 years, 3 to 5 years. In fact, they are almost at equal level. So the good part is we will have good Q&A in this program, in the live program also in the WhatsApp group. So you will get to learn from people who are experienced to medium level experience to no experience. So you will learn from each other as well. Yeah. All right, let's move on. Next, what is total expense ratio, TER, or simply expense ratio? It is the annualized charges incurred by an investor for investing in a mutual fund scheme. Now, when you're in, those who are investing in mutual fund scheme, you know that no one asks you to cut a check. The mutual fund company never tells you that, cut a check and give it to us because we are managing your money. So we need money to run the company, right? They don't do that. Why? Because they automatically deduct the amount from your investment and the remaining amount gets invested, right? Now, how does it happen? Let's take an example. Let's say the expense ratio of a scheme is 2% and you invested ₹100 in that scheme, right? It means in the next 1 year, 2% is for 1 year. In the next 1 year, ₹2 will be deducted. Now, let's take a hypothetical situation. Let's say the scheme in which you're investing into, they invested in 50 stocks. And after 1 year, the price of those 50 stocks or the price of every stock in the market is same as it is today. Not possible, but hypothetically, the price of the stocks is same as it is today after 1 year also. In that case, your ₹100 should remain ₹100 because you invested ₹100 today. Next year also should remain ₹100. But no, your money will erode down to ₹98 because the company would have deducted ₹2 over the next 1 year. That's how the expense ratio or the charges are impacting your returns. So you're down by 2%. Now your portfolio is in loss by 2%. Not because the market is down, but because the expense ratio is 2%. Clear? Now, let's dig it a little more further. expense ratio is deducted every day. What does it mean? Every day का मतलब ये नहीं कि every day 2% होता है, नहीं. 2% divided by number of days. So NAV of a scheme is reported after deducting these expenses. Let's see how. Let's say there are 250 trading days in a year. Trading days means Saturday, Sunday को market में trading नहीं होती, national holidays पे नहीं होती. Remaining there are approximately 250 days on which the market is running. So 2% divided by 250 is 0.008%. Right? Now let's assume the size of a scheme is 1,000 crore rupees. Total, all the investors put together have given 1,000 crore rupees to the scheme, and that scheme has invested that money into stocks. Right? Now, what is 0.008% of 1,000 crores? 8 lakh rupees. So every day, 8 lakh rupees is deducted. Deducted means from the mutual fund scheme, 8 lakh rupees is taken out, and that amount comes to the bank account of the mutual fund company. अगर HDFC है, L&T है, SBI है, जो भी म्यूचुअल फंड कंपनी है, that 8 lakh rupees comes to their own company's bank account, and then the NAV is declared based on the remaining fund in the scheme. I hope this is clear in the background how the charges are getting deducted. So if you're investing in a scheme for next 6 months and the expense ratio of the scheme is 2%, that means in the next 6 months, 1% will get deducted. Why? Because every day they are deducting. They're not deducting 1-2% on day 1 or on day 365 days. If you're investing in a scheme for 1 month, in that same proportion, that charges will be deducted, right? But they are getting deducted every day. I hope this is clear. Let's take an example. HDFC top 100 fund. Close a few windows. So HDFC top 100 fund. Let's look at the expense ratio. Look at it on your left hand side. Expense ratio is 1.79%. Right? Let's take another scheme. Now there are some parameters or some laws which define how much they can charge. Let's not get into that. It's important just to look at the number as an investor. That's what is important for me. For this particular scheme, the expense ratio is 2.11%. So it can vary from 1.5% to up to 2.5%. Typically it varies. Right? So this is again you have to look at. Now I don't think so. I have to before that. What are these charges for very again common sense thing? Salaries of the team, agent and distributor commission, legal and audit fees, selling and promotion expenses, and other general operational expenses to run a scheme or a company, right? And I don't have to convince you, the lower the better. As an investor, I want the expense ratio should be as low as possible. I mean, why not? Right? So this is clear that I want the expense ratio to be as low as possible. Again, this is not to be looked in isolation that expense ratio iska kam hai, uska zyada hai, so this scheme is better. No, not necessary. But if I look in isolation, then this is what I want. But I'll look in a balanced way, and that's what I'll learn in this program. Right? Next, I'm continuing with the expense ratio. How many of you are aware of regular versus direct plan? Every scheme has got two options. You want to invest in regular plan or direct plan. Are you aware of it? Yes or no? Are you aware what is regular plan and what is direct plan? Okay, most of you are saying yes, some of you are saying no. Okay, got it. Even if you're aware of it, you will get some more insights, I believe. And I'm not talking in favor of any particular scheme. This is an educational program. I am not talking in favor of any particular product. I'm going to tell you the pros and cons of both. What is the pros and cons of regular plan? What is the pros and cons of direct plan? So I'll talk about both. There are 2 slides, so hold on before you take any judgment call. So number 1, when you buy a regular plan, when you are dealing with an advisor, broker, agent, or a distributor. MFD is what? Mutual fund distributor. So if you have some agent or advisor who is advising you or managing your mutual fund portfolio, most likely that person has got an MFD license, right? And when you are investing through any channel or any individual or any platform, you are investing in a regular plan, most likely, right? I'll talk in more detail, with hold on for that. Even your bank and brokerage house is a distributor. For example, you're investing through ICICI Direct. It's a distributor. They have got an MFD license. So they are making you invest in regular plan because that's how they will make their money. They will get their commission from the mutual fund company. They don't charge you anything directly. They get their commission from the mutual fund company. Even your bank relationship manager. Let's say you have a bank account in HDFC Bank and you're investing in a HDFC mutual fund scheme. So a lot of people think that I'm investing in direct scheme. No, you're not. HDFC Bank is a mutual fund distributor. They have a license number. They are making money from their subsidiary called HDFC Mutual Fund. So HDFC Mutual Fund commission deta hai HDFC Bank ko. So just because you're investing in the same company's mutual fund scheme does not mean you're investing in the direct plan. No, you're investing in the regular plan and they're making commissions. Nothing wrong in that. I'm just telling you for the sake of information, right? Now, TER, that is the total expense ratio, is higher in a regular plan because approximately 1% commission goes to the intermediary. This happens per annum. This is not one time. So as long as you're invested, every year they're getting some commissions, right? Now, direct plan can be bought directly from the fund house or from various platforms. I'll talk about platforms on day 3, right? Now, example lete hain, Motilal Oswal Mid Cap 30. Let's go to the scheme and again watch very carefully. This is, I'll tell you about these websites also. I'll mention in the email which websites are these. I'll give you the link. So just right now, just focus on the concepts. Now, this is the name of the scheme. Just below this, it says regular plan, right? Let's go down. Look at the expense of the scheme, 2.22%. Clear? Now let's go up and I change it to direct plan. Same scheme has got both options, regular plan or direct plan. Now let's go down. Look at the expense ratio, 0.93%. That's a difference of 1.29%. So 1.29% charges are more in a regular plan of the same scheme compared to the direct plan of the same scheme. You are paying 1.29% charges more, which means you will earn 1.29% returns less approximately when you're investing in a regular plan of the same scheme. I'll come to that. Let me explain further. Some people might not have understood. Let me explain the concept from a property deal. Let's say you own a flat which is worth 50 lakh rupees and you want to sell that. You'll talk to a few brokers, let's say 2, 3, 4, 5 in your region, and they'll come and visit the property and you'll tell them, this is my ask, this is the property, you can look around and this is what I'm expecting. Now they'll bring customers, property site visit only and all that. Let's say they create, one of them cracks a deal and you finalize one buyer. 50 lakh rupees is what you get after whatever, final rate is 50 lakh rupees. Now, because there was a broker in between or agent in between, you pay 1% commission to them. That is 50,000 rupees, right? Clear? That's what happens in a property deal. Now, let's assume instead of going through a broker, you got in touch directly with someone, maybe your friend's friend or colleague's friend or a neighbor or someone who was interested to buy that property. In this case, again, you get 50 lakh rupees with you, but because there is no broker or agent in between, you save your 1%. That's what happens. But in both these scenarios, with broker or without broker, everything else remains the same. Same seller, same property, same location, same dimension, same size, same specification, everything is same. The only thing difference is there was someone in between because of which you gave away 1%. They charge for their service and you were happy to do that because that's what was agreed upon. Right? Now bring this to mutual funds. Whether it is Motilal Oswal mid-cap regular plan or direct plan, fund manager is same. The topmost guy is same. Number of stocks in both the categories is same. Everything in the mutual fund scheme is same, except that there is someone in between in the regular plan who's taking 1% cut from the mutual fund company. That's why mutual fund company is charging you more so that they can pay that 1% to them. Simple. Eh? Now let's take an example mathematically. Let's say you are doing an SIP of 25,000 rupees per month in a regular plan and same SIP of 25,000 rupees per month in a direct plan of the same scheme, right? And you do this for next 30 years. Now the assumption here is that you're not increasing your investment amount, which is impractical. 30 years is a very long time. You will definitely earn more, save more, and with inflation, you will save more and invest more, and your amount will increase. But for the sake of calculation and for the sake of understanding, we're keeping the amount constant for next 30 years. 25,000 rupees per month you're investing, right? In a regular plan of the scheme, let's say you made 12% returns. In the direct plan of the same scheme, you will make approximately 13% returns. Why? Because you are paying less charges in direct plan, 1% less charges. Who is benefiting out of that? You. So you will make 1% returns more. Why? Because you're charging 1%. You're getting charged 1% less. That 1% is going to you ultimately, right? Now, after 30 years, this is the final amount. In a regular plan, 7.7 crores you will make. In a direct plan, you will make 9.4 crores. That's a difference of 1.7 crores. This is assuming that the amount is not increasing. If the amount is increasing, the difference will be more. So that's the impact of 1% in your portfolio. That's how important 1% is. But as I said a few minutes back, I'm not encouraging one plan, one category over other. There are pros and cons to everything. So let's talk about the other side. Now, do not invest in a direct plan just for the sake of 1%. Yes, 1% is important, but I have also seen so many cases where people move to direct plan for the sake of saving 1%, which is fine, nothing wrong in that, but they are not sure, or they do not devote enough time and energy to monitor the portfolio. And they end up making 4-5% returns less compared to what they were making with the advisor. And now there are ego issues. They don't want to go back to the advisor also. Why? Because it will be like, oh, aa gaye wapas, line pe aa gaye wapas. So that, that ego is stopping them to going back to the advisor. So please keep that ego aside. It's about your family's future, your financial future. Even if you have moved to direct plan and you realize now the returns are less, why? Because you have your full-time job, full-time business. You're not able to monitor and take out time for that. That's why you wanted someone to do it for you. Instead of saving 1%, you end up losing 3-4% returns, right? And that's why it is called penny wise, pound foolish. Must have heard of it, right? Don't be one. Don't be penny wise and pound foolish. Just for the sake of saving 1%, don't lose 3-4%. It's not worth it, right? And don't go and argue with your advisor today that you are making so much money now. I've realized, and what you have done, this and that. They are working for you. They are working for your own benefit. Just let this program get over, and Monday you take a call. Don't worry about right now how much you have paid in charges and all that, all kind of stuff. Right now, advantages of regular plan basically is you get advice on creating and monitoring the portfolio, number one, and plus support in back-end operational work. Now, it might look simple, but KYC, re-KYC, bank mandate, increasing the SIP amount, decreasing the SIP amount, stopping an SIP, withdrawing the amount, starting a new SIP, it takes an effort. It takes some effort. So if you want someone to manage that on your behalf so that you can focus on your career, there's nothing wrong if they make 1% out of that. Provided they are giving you the appropriate service and the appropriate returns in the long run, of course. Right? Now, one mistake which people are making. How many of you, tell me in the chat box, how many of you are investing through, let's say, ICICI Direct or SDC Securities or any other channel which is making you invest in regular plan, but you are the one who is doing everything. You are the one who is choosing the scheme. You're not taking any advice from anyone. You are the one doing all the back office work. You are investing through regular plan, but you are doing everything yourself. You are your own advisor. You are your own back-end operation team. If that is the case, then it's a mistake, because then you're paying 1% and not taking any service. NJ Wealth is regular, Tabrij. If I'm correct, NJ Wealth is regular. Are they charging you anything? Simple question. Are they charging you anything? No. Apriti is confirming. It says yes. If the NJ Wealth is not charging you anything, it means they're making money from the mutual fund company. They're making you invest in regular plan, right? So the point is, there is nothing wrong in investing in regular plan, but if you're investing in regular plan and not taking any service, any advice, then definitely you are losing 1%. So daan kar rahe ho. You are donating money to $1 billion company or $1 million company. That's a mistake for sure. Yeah, I hope this is clear. Okay, before I go to Q&A and then a break, I know so a lot of you have joined late. I'll just quickly go through this slide again, and then we'll go to the Q&A, and then we'll take a short break. Number one, refer to MFEP index, which has been shared twice in your emails today. This is the index. So whatever topic question comes in your mind, first look whether this topic is mentioned in the index. If it is mentioned in the index, it means it will be covered in the program. So don't ask this question in the Q&A box. Hold on, have patience, right? Abhi questions वही पूछो जो जिस topic पे बात हो रही है, right? Ask questions only in the Q&A box, not in the chat box, and only relevant to equity mutual fund, not stocks and financial planning and all that. There is a lot to be discussed in finance arena, but we're talking only about one topic, and we are making sure that we become laser sharp, focused, and expert in this one area, right? You have already seen I'm taking questions in the regular interval, and as I said, ask questions relevant to the topic. Now, if I'm missing a question, don't take it personally. It's not intentional. Ask again. If I still miss it, ask in the next Q&A or the end Q&A. If I still miss it in the entire session, please ask in the WhatsApp group. Next Sunday, I am with you. There is no chance I will miss your question. You will get every question answered in this next 8 to 9 days. Yep. Let me start the timer, and then we'll start with the Q&A. Why not to see the past performance of fund for more than 10 years? Venkatesh, hold on. Abhi session shuru hua hai. Abhi to bahut kuch baki hai. We are not even, what we not even done 10% of the program. जब मैंने बोला वो सीक्रेट तो डेफिनेटली मैं कवर करूंगा, चांस ही नहीं कवर नहीं करूंगा. पेशेंस. How fund manager invest in stock based on stock weightage in Nifty or Sensex? How का मतलब समझ में नहीं आया संजीव. They have the all the tools with them, the NSE BSE is providing or whatever the backend management is. They are able to do that because they are able, they have the facility to do that. It's very simple. It's all automated. Is direct growth and direct plan the same? So direct growth का मतलब direct scheme में invest कर रहे हैं और growth में कर रहे हैं. एक होता है डायरेक्ट डिविडेंड, मतलब डायरेक्ट प्लान में इन्वेस्ट कर रहे हैं, रेगुलर और डायरेक्ट में कर रहे हैं, और डिविडेंड स्कीम में कर रहे हैं. I told you different kinds of schemes, growth versus dividend, regular versus direct, right? So there can be direct growth, regular growth, direct dividend, regular dividend. There can be different permutation combination. Next question. Do direct plans reinvest the dividend? If yes, does the number of units increase in portfolio? No, Vivek, yes, they do reinvest the dividend, but units increase नहीं होती, NAV की value increase हो जाती. But that also depends on, depends on the performance, because in general stock market में अगर आप देखोगे, if a company is declaring dividend of 10 rupees per share, their price will come down by 10 rupees. पर वो that is theoretical. Why? Because there are so many factors affecting a stock price at one point in time. You can't see it going down by 10 rupees precisely. But theoretically and technically, if any dividend is declared, be it by mutual fund scheme or a stock, the price of that stock or scheme goes down by that amount. So direct growth is a good idea. Yes, if you are depending on your text, of course, Varshika, but we will discuss more about growth versus dividend on day 3. And whether the direct is good or regular growth, that's something you have to take a call depending on your choice, whether you want advisory or backend services or not. If I need 1 crore after 5 years, how much do I need to invest on every month? Karthikeyan, बहुत simple है. Google पे जाओ, लिखो return calculator. उसमें values डालो, कोई random value डालो, amount लिखो, number of years लिखो, percentage returns लिखो. How much percentage returns you will get to know tomorrow. I'll give you some benchmark, and then you can calculate. ये बहुत simple है. ये question के answer Google पे मिल जाएंगे. If regular plan is to be offered through an intermediary, then why are they available online on the AMC's website itself? So that's a thing you have to ask them, because in that case the AMCs make more money. Ideally they should allow. I think there are both options available. अगर directly AMC की website पे जा रहे हैं, you should be able to invest in direct plan, right? But understand, ICICI mutual fund is a different company. ICICI direct is a different company. Again, don't get confused. SDFC mutual fund is a different company. SDFC securities is a different company. So SDFC securities की website पे जाके अगर mutual fund में invest कर रहे हो, they will make you invest in regular plan. Don't confuse SDFC है तो एक ही घर के हैं, नहीं, एक ही घर के होंगे, but they are different entities. Investing in UTI mutual fund dividend reinvest, is it direct or regular plan? That depends on, I mean, look at the name of the scheme. Name of the scheme में कई बार लिखा होता है direct या regular. Direct होता है, usually direct लिखा होता है. अगर लिखा हुआ नहीं direct, it means it is regular. Is expense ratio charged only for first year after investing, or is it charged till we invested? Every year, Sachin. घर कैसे चलेगा? Business कैसे चलेगा? मैंने 10 लाख रुपए इन्वेस्ट किए, अगले 10 साल के लिए मैंने उसको कुछ भी नहीं किया. So company will charge me only first year. Next 9 years they will serve me for free. How will they run their business? Every year it is charged. 10 lakhs का 1% is 10%, 10,000 rupees. हो गया. Next year value of the portfolio becomes 12 lakhs. 12 lakhs का 1% is 12,000 rupees. Next year the market is down, it becomes 9 lakhs. 9 lakhs का 10%, 1% is 9,000 rupees. Every year they are charging. Of course, that's how an agent or the distributor will also run their business and household, and that's how the companies will also run their business. Chirag will cover all this, Zerodha, Grow and Paytm. This will cover on day 3, different platforms which are making you invest in direct plans. I'll cover that on day 3. While calculating monthly SIP amount for client, should we reconsider inflation? Anurag, that's I think a financial planning question. I mean, I can't really answer in what. I mean, there's no right answer to that. Inflation तो है ही, तभी हम equity में invest कर रहे हैं. Equity market में invest करने का purpose ये है कि you can beat inflation. But I didn't get your question. What context are you asking? It's more about creating the financial plan and then taking a decision. Does the mutual fund company has to get prior approval from SEBI or NFE to change expense ratio? I don't think so. They have to take approval. As far as they are changing it as per the guidelines, they don't have to take any approval. In fact, guidelines के बाहर कर ही नहीं सकते. Guidelines के अंदर कर रहे हैं, approval के लेना है. They have to undergo audit. If they're doing anything apart from the guidelines, they will get punished sooner or later. हाउ डू वी रियली फाइंड आउट और इन्वेस्ट इन डायरेक्ट प्लान? विवेक, इसलिए तुमने ये कोर्स ज्वाइन किया है. होल्ड ऑन, यू विल नो कि कैसे इन्वेस्ट करना है डायरेक्ट प्लान में, वो प्लेटफॉर्म्स कौन से हैं, और डायरेक्ट में करना है तो उसके लिए क्या सीखना है. दैट्स व्हाट यू आर हियर फॉर, right? So after the program, you may still want to invest in regular plan, or you may want to invest in direct plan. That's a call you have to take. You will be able to take that call after Sunday. Standard turnover ratio, I don't know. Turnover ratio hoga wo, Anurag, I'm not sure. Can you maybe share the link? Where did you read that article, or maybe some website? Portfolio turnover ratio बोल दो, या उसको maybe standard turnover ratio कोई बोल रहा है तो मुझे पता नहीं. I'm not sure. How as expense ratio is deducted in SIP mode? संजीव, बहुत सिंपल है ना. expense ratio is getting deducted every day. So आज जो फंड की वैल्यू है आपकी, उसका 2% डिडक्ट हो रहा है. अब आपने 15 दिन बाद कोई SIP कर दी ना, आपकी फंड की वैल्यू थोड़ी सी बढ़ गई, तो जो भी फंड की वैल्यू है उस दिन जब वो डिडक्ट कर रहा है 0.008%, वो उस दिन की फंड की वैल्यू के ऊपर कर रहा है. सिंपल है. उसको मतलब नहीं है आप SIP कर रहे हो, लमसम कर रहे हो. द डे दे आर डिडक्टिंग, एवरी डे दे आर डिडक्टिंग द एक्सपेंस रेशियो. उस दिन जो आपकी मार्केट वैल्यू है आपके फंड की, आपके इन्वेस्टमेंट की, उसका 0.008% या 0.009% जो भी है वो डिडक्ट कर देंगे. आई होप दिस इज क्लियर. Okay, hold on everyone, hold on to the questions. Let's move to the break. Before we go to the break, there's a one survey form which we shared on the email also, and also on the WhatsApp. Majority of you have filled that, so a big thank you for that. Those who have not filled, a humble request, please do fill, because we read all these forms and it makes a difference to what all we cover and how do we take care of your questions and your concerns. So please take out 60 seconds from your life. I'm putting this in the chat box. I put in the chat box में डाल दिया मैंने इसको. Please look at the link. Click on the link. Take out 60 seconds. It's a 5-minute break. The break is starting now. In the meanwhile, please fill the form if you have not done that. Okay, I am talking in English 99% of the time. If I'm talking 1% here and there in Hindi, don't worry, you're not missing out on anything. थोड़ा naturally निकल जाता है, but you're not going to miss out on anything when I talk in Hindi. So don't worry. Yeah. All right, your time starts now. 5 minutes break. time up. Please come back. All right, let's start. Okay, next. Okay, by the way, I have talked about turnover ratio and expense ratio so far. I have not given you any range or benchmark in terms of that expense ratio beyond this is bad or turnover ratio beyond this is bad. No, we have to compare them to the peers. This is something you will learn tomorrow when we do live demonstration of how to select schemes. So the answer is there is no right answer to what is the good turnover ratio or what is a good expense ratio. You have to compare them to other peers or other competition in the same category, right? So don't worry about that. I'll come to that tomorrow. Okay, next is size of the fund. The size of the fund or AUM, asset under management, can change for two reasons. A size of a mutual fund scheme can change for two reasons. Number one, the investment or withdrawal by investors. Let's say the size of the mutual fund scheme is 500 crore, which means all the thousands of mutual fund investors put together, they have given total 500 crore rupees to the scheme. And that scheme's fund manager, based on his or her research, has invested that 500 crore rupees into stocks. This is what typically is happening, right? Now, if there is more investment by the investors, the scheme size can go from 500 to 600. Simple. And if there is withdrawal by investors, it can also go down from 500 to 400, right? And the second reason it can go up and down is the stock price of the stocks in the scheme. Again, look at your demat account. If you have investing in stocks, what are the reasons based on which your stock price, your portfolio can go up and down? Let's say your portfolio size is 10 lakh rupees in stocks. If you invest 1 lakh rupees more, it will become 11 lakhs. If you withdraw 1 lakh, it will go to 9 lakhs, right? Let's say you don't invest, you don't withdraw, but the stock prices are changing every day. So 10 lakhs can become 12 lakhs, 13 lakhs also, it can become 7 lakhs also, depending on the stock price. The same thing is with the mutual fund scheme. So the AUM of the scheme or the size of the scheme can change for two reasons. One is investment and withdrawal, and second is change in the stock prices. Now, the rule by the SEBI is a scheme cannot invest more than 10% in a single stock, that is a principal amount. For example, if scheme has got total 100 crore rupees of assets from the different investors, total all the investors put together, they cannot invest more than 10 crore rupees, that is 10%, in a particular stock. I am saying principal amount, but there is a possibility that one stock performs very good compared to other stocks, and the current market value in that scheme, the current percentage of that stock in the scheme becomes 14%, 15%, even 20%. That is possible, but from principal amount, they cannot invest more than 10%. Again, same thing. Look at your demat account. You have 10 stocks. That's you invested 10 rupees each in all of them. But one stock has performed better. Now, if you look at your portfolio after 6 months, after 1 year, after whatever time, you will see one stock has become value, 10 rupees has become 12 rupees, one has become 8 rupees, one has become 9 rupees. Why? Because stock price has gone up and down. Same thing can go here. But principal amount cannot be more than 10%. Now, good performance of a scheme will naturally lead to more inflows. If a scheme is doing good, more and more investors will come and invest in that scheme. The existing investors will also invest more in that scheme because the performance is good. Of course, everyone wants to participate in that, right? Now, the problem here is when the size of the scheme keeps on increasing, it makes the fund manager task very tough, especially in mid-cap and small-cap schemes. Hold on, I'll explain you. With more inflows, the fund manager has no choice but to invest in low-quality stocks. Let's understand with example. And it's not easy to buy huge and buy and sell huge quantity in small cap schemes specifically, right? Example, let's look at the scheme, SBI small cap. Now, this is very important. Size of the scheme, in my opinion, is the most important criteria and the most ignored criteria while selecting or while buying or selling a mutual fund scheme. So look at the scheme, SBI small cap. If you go down, look at this assets, or you call it size, or you call it assets, you call it AUM, one and the same thing. It is 11,831 crore rupees. That is the total amount of money which investors have put in the scheme, and the scheme has invested this amount into stocks, right? Let's go down and look at the number of stocks. 50. So this 11,000 crore rupees has been invested across 50 stocks, right? Now, let's take one example. Nippon India small cap. Look at the size of the scheme. Assets are total 18,675 crore rupees. Go down. Number of stocks is 151. SBI small cap, same category. Nippon India small cap, same category, right? They are competitors to each other. SBI small cap fund manager is investing in 50 stocks. Nippon India small cap fund manager is investing in 151 stocks. Now, do you think there are 151 good stocks and SBI fund manager is not aware of that? That's why these poor guys investing only in 50 stocks? No. The fund manager of this scheme, Nippon India, has no choice but to move to other stocks. Why? Because the fund size has become so huge that there is a certain practical limit to investing in a particular stock. Yeah. Now you might say 10% is of the principal amount. If the principal amount is increasing, if more flows are coming in, they can keep on investing in the same stock because it can not go beyond 10% because new funds are coming in. But there is a problem. Let's go down and explain you in more detail. Look at this. Then same scheme, India Nippon scheme I'm looking at. They have just displayed some top holdings of the scheme, top stocks in the scheme. Tube Investment of India, 2.77% of assets, means total whatever is the value of the scheme, 18,000 crore something, out of which 2.77% money is into Tube Investment of India. This is as per market value, not as per investment value, principal amount. The same goes for other stocks. 2.5. This is the top 2.77, then 2.5, and then 2.5, and it is going down gradually. Right? Let's take an example. Let's take this company called Orient Electric. Yeah, total 1.45%. So let me go to a particular website called Screener. Orient Electric का थोड़ा सा डिटेल में देखते हैं. Let's understand this concept. Orient Electric. I just explained you what is market cap. Market cap is the total size, the total worth of the company. This company is worth 5,727 crore rupees. Right? Now a question to all of you. This scheme I just told you about is investing 1.45% of what? 1.45% of this 18,675 crores. Can someone open their calculator and tell me in the chat box what is 1.45% of 18,675 crore? Tell me your answer. What is 1.45% of 18,675 crores? 83 crore. Is that correct, everyone? Any other answer? Okay, 83 crores, right? Are you sure? 1.45% of 18,675 crores. 274 crores. Is that the right answer now? It should be around that much. Yeah, 270 crores. Now come back to this. Now do one more calculation. 270 crores is the total amount of money invested as on today in this company called Orient Electric. Now divide 270 crores by 5,727 crores. Tell me what's the answer. 270 crores divided by 5,727 crores. What is the percentage? 4.7, 4.8. Any other answer? 4.7 ले लेते हैं. ठीक है? Now understand a very common sense basic thing. This scheme called Nippon India Small Cap has invested, has a stake or has a holding of 4.7% in this company called Orient Electric, worth rupees 270 crores. After few weeks, few months, or let's say few years, the research of the fund manager says that he wants to sell this stock. That's what the job of the fund manager is. He's supposed to do the research and sell and buy accordingly. Now, if he wants to sell stocks worth 270 crore or 4.7% of the company, what will happen in the stock market? What will happen in the stock market to the stock price of this company? Think. Tell me in the chat box. What will happen to the stock price if 270 crore worth of stocks have come in the market for selling? It will go drastically down. Stock price will drop. Steep down, steep fall. Yes, that's where the problem is. And that will impact the returns of the scheme and of course the returns of the investors. right? So this is the dilemma of the fund manager. Even though they can invest up to 10% of the principal amount, but look at the highest value here, 2.77, 2.51, 2.5, 2.07. They're not even nowhere close to 10%. Especially in small cap and mid cap, this is the problem, especially small cap. Mid cap में भी problem है ये, because mid cap hardly 150 stocks are there in mid cap category, right? So just because you have got a huge fund size does not mean you can invest any amount in any stock. You have to diversify to other stocks, and you end up buying low quality stocks, because at any point in time, number of good quality stocks is always limited. We don't have hundreds of stocks or tens of stocks which are good quality stocks. So fund manager has to go to B category and C category stocks because the fund size is increasing by the day. Now this is like a catch-22 situation or a dilemma for the fund manager. Why? Because at one point they want to grow. Every scheme wants to become big. And the moment they become big, the chances that they will start underperforming now becomes very high. So you might have noticed a lot of times this happens. You invest in a scheme looking at the past performance, and the moment you start investing, the scheme performance starts going down. This happens because you ignored the fund size. So in my view, again, I'm telling you, fund size is the most important criteria while buying or selling a scheme. And let me tell you, this is the toughest criteria to implement. And you will realize why I'm saying that in the coming week. Coming week, when you have to implement whatever you have learned in your portfolio, you will understand why am I saying that this is the toughest criteria to implement. Because man nahi manega, dil nahi manega yaar, nahi yaar, just because the scheme size is high, why should I sell it? But hold on, don't worry, till Sunday काफी कुछ clear हो जाएगा. Now, one more thing, minimum AUM or minimum size I'm looking for all categories is 1,000 crores. I don't want to invest in a scheme whose fund size is less than 1,000 crores. And there are two reasons behind that. Number one, if the fund size is very low, the expense ratio is high. Why? Because there are most of the cost is fixed costs, office expenses, employee expenses, marketing expenses. In fact, if a size is low, marketing expenses are more because they want to promote more and they want more investors to come in. So marketing expenses are more for a small size scheme, right? So the total charges divided by the size of the scheme, the percentages becomes high, and that's why the expense ratio becomes high. So that's one reason. Number two, now this reason is more from psychological point of view. I don't have any objective proof to show that, but I'm just from human psychology. If you look at, understand the pressure or the the mindset of a fund manager. Let's say there's a fund manager who has got a fund size of 200, 300, 400 crores, right? And they have got pressure from the company, from the management, from the senior that we have to grow the size. There are only two ways to grow. Number one, you perform very well, exceptionally well. Your stock price, the stocks which you choose goes really perform very well. And, the market recognizes you eventually. The second is, they do a lot of marketing and people come in. So whatever marketing has to be done, that is management is doing. Fund manager ka koi problem nahi hai. He's not concerned about the marketing, but he is concerned about his performance, right? Now, just to meet that pressure or just to be in that elite group of high performance fund manager, they end up investing in very aggressive stocks, very high risk stocks. They end up taking high risk. Why? Because one, they are not in limelight right now. There are very few investors who are investing in the scheme. That's why the fund size is low. And they are like R ya par. Either we'll do very good or we are anyway not doing good. How does it matter? How many people will notice? Media will hardly come to us. They will hardly quote us that they are not performing because they're anyway not quoting us in the news, in the media. So why will they bother? Right? So the fund manager ends up being very aggressive. I'm not saying everyone does that, but that is this is something based on whatever I've heard or spoken to or discussed with various stakeholders in the industry. This is a very common human behavior. Nothing right or wrong in that, but they want to perform well, and that performance pressure, they end up taking very aggressive calls, right? And I don't want to invest my hard-earned money on luck. I want to invest on skill and research and patience. So these are the two reasons because of which I want to invest in a scheme which has got some substantial, some decent amount of assets, because then they come in limelight. Now there are a lot of investors who are investing in the scheme. 1,000 crores, 2,000 crores is the AUM, and they cannot take the risk of being, carefree and, being very lenient with what they are investing into. Why? Because now they will come in media if they do anything like that. So now they are more careful because they are in limelight, right? So I want the scheme size to be decent, at least at 1,000 crore rupees, right? For other categories, large cap funds, I do not want to invest in a scheme which is more than 17,000 crores worth. Small cap, mid cap, I don't want to invest in a scheme whose size is more than 14,000 crores. And for small cap, I don't want to invest in a scheme whose size is more than 10,500 crores. Right? Now, how is this coming up? Firstly, this is based on my 15, 16 years of experience, looking at the performance of the scheme. And this has been going for very long, and it's a tried and tested model. You will also learn over a period of time through experience or maybe through data. But this is what the upper limits are based on the experience of last 15, 16 years. Number one. Number two, this upper limit and lower limit will of course change. Why? Because the market will go up and down. Now, how will you look at that? That depends on the index. And this exercise, small exercise, I will show you on day 3. So hold on to that question, that after 1 year, the 17,000 can become 18 or maybe 15. This 14 can become maybe 16 or maybe 12. How will I determine that? I will explain you that with a simple calculation on day 3. So hold on for that, right? Now, some people might not be very comfortable with this concept. They might say, is fund size really important? Are you sure? Now, you might be aware, some of you, there are some schemes who have stopped taking inflow. They have stopped taking new investment from investors, either in the lump sum form, or they have capped the limit of investment you can make in that scheme. Can you name a couple of schemes? Anyone in the chat box? There are a few schemes which have stopped taking lump sum amount, or there is a limit to lump sum amount, or there is a limit to the SIP amount, and you cannot invest more than this amount in that scheme. Anyone? Name of the scheme. Mirai to बहुत बड़ा एक fund house हो गया. There are multiple schemes within Mirai. SBI small cap. Mirai emerging blue chip. Okay. Yes, that's right. Mirai blue chip. Right. Now, can you understand this basic concept? They are into the business of selling mutual funds, and they are saying no to the customer. They are saying no to earning money. Isn't that a very big call? Why will they do that? Because they know that the fund size has become so big that if we keep on taking more funds, fresh funds at an unregulated manner, we will start underperforming. Forget about making more money. We will come in bad limelight, or we will come in the bad books of the investors, and we'll go down the drain. And they care for that. They care for their existing investors also, and they care for the new investors also. They don't want them to just get into the scheme just because the past performance has been good. They know that the size has become unmanageable, and they can't just keep on increasing the size left, right, and center. It's a very big call which they have taken. Right? So few funds have stopped the fund size. That's a testimony to the fact that fund size is very important. Saying no to business is not easy. Please understand. Yeah, I'll talk more about size in the next couple of days. You will eventually understand. Number of stocks, very simple. Lower is the better. Now, lower does not mean I want it to be 10 or 12 or 5 or 6. Anyway, they have to invest at least in 10 stocks, because maximum they can invest in 10%. But typically you will have 25, 30, 40, 50, 70, 80 stocks in a mutual fund scheme. But I want it to be lower as low as possible. Why? Because then they have the buffer to invest in more high quality stocks. If a scheme is investing in 50, 60 stocks, they can have a few more stocks when the fund size increases. But if a scheme has got 120, 150 stocks already, what more options do they have in terms of adding more quality stocks to the scheme? Understand that. As I told you, you cannot have n number, innumerable high quality stocks at any given point. There are limited stocks which are good quality stocks. Right? So the number of stocks, lower the better. Next criteria, past performance. Now, within past performance, there are two things. Number one, trailing returns, and number two, rolling returns. Both we are talking about compounded annually returns. So let's look at trailing returns first. Now, trailing returns might sound like a technical term. है कुछ भी नहीं. Trailing returns का मतलब past returns कितने आए. For example, if you have a FD which has matured today, you did it 5 years back, the FD matured today, and you got a return of 6.5%. That is trailing return. It is always in compounded. 6.5% is annualized return, right? So it is said like this: the trailing return of this scheme is this, or this particular investment is this. or you invested in a property 10 years back, today the amount is X, Y, you invested X, today is Y. You calculate the returns, CAGR, compound annual returns. Same thing, compounded annual returns, you call it annualized returns, or you call it CAGR returns, or you call it trailing returns. The one and the same thing. Right? So don't get confused between what is trailing return, it's the same thing. So if you go to MF research, this, I'm just moving the cursor here. This is advisorcoach.com, and you go to the first link, mutual fund trailing returns. You go down, you can choose the category. Let's say I choose equity mid cap, and I want to look at 5-year trailing return. I want to see the table in the ranking of 5 years, and I submit. Look at this. Now this is ranked. Look at it. Can you see the color here? So this is rank number 1, then rank number 2, number 3. So they are ranked as per 5-year return. So this scheme has given returns of 16.93%. This is the trailing return of last 5 years. It means annualized, you would have made 16.93% returns if you invested in this scheme 5 years back. Right? Then 15.04, 14.96, 12.32, and so on. All these are trailing compounded annual trailing returns or compounded annual returns or annualized returns or CAGR returns of last 5 years. Right? Now, I'll come to rolling returns. Before that, always compare returns with benchmark and category. What is benchmark? The index. What is category? The other schemes in the category. Right? So let me ask you a question. I am telling you that this scheme has given a return of 11% in last 1 year. Is it a good scheme or a bad scheme? Tell me in the chat box. A scheme has given a return of 11% in the last 1 year. Is it a good scheme or a bad scheme? Good scheme. Good scheme. Depends. Can't say. Good scheme. Can't say. Compare with peers. Need to compare. Yes. I just told you, always compare returns with peers and benchmark. Right? Now, let's say this scheme has got 11% returns. All the other schemes in the peers, in the category, small cap, mid cap, whichever large cap category it is into, most of the scheme, 95% of the schemes have given returns more than 11% in last 1 year. Now, is it a good scheme or a bad scheme? 95% of the schemes in that category has given more than 11% returns in last 1 year. Now, is it a good scheme or a bad scheme? It's a bad scheme. Why? Because it is one of the worst performing schemes compared to the peers, right? One more question. A scheme has given a return of minus 10% in last 1 year. Negative. Good scheme or bad scheme? Good scheme or bad scheme? Minus 10% returns in last 1 year. Think and tell me, good scheme or bad scheme? Again, some people are saying good, bad, bad. Why? How can you say it is bad? Compare. All the other schemes in that category has given returns of minus 15, minus 20, minus 22%. So minus 10 is better. So this scheme is better scheme. This is a good scheme. It has given only minus 10% returns, whereas other schemes have given minus 20, minus 30% returns. Now, let's say someone invested in March, April 2019. Someone started their mutual fund investment journey in March, April 2019. In March, April 2020, the entire market was down. Every scheme was giving negative returns. Does that mean every scheme is bad? Every stock is bad? No. Compare with peers. And that's why it is recommended to invest in stock market for more than 5 years. Or I am recommending at least. If you are investing in mutual funds, equity mutual funds or stocks for less than 5 years, let me assure you, you are a gambler. Nothing wrong in that. अपनी मर्जी है क्या करना है लाइफ में, जो करना है करो. You do whatever you want to do in life, but be assured that you are a gambler, you are a juari. Just accept that. If you are investing with a horizon of less than 5 years, equity market is not meant for less than 5 years. If you are doing that, fine. It's your money, your hard-earned money. तुम्हारी मर्जी, तुम्हारी जिंदगी है आपकी, मर्जी है आपकी. It's your life, it's your choice. Right? So if you're investing for less than 5 years, stay away. Don't do that. Because in 1 year, even someone who started investing in March, April 2017, their portfolio was in loss in March, April 2020 after 3 years. But if you look at today, March, April 2020 and onwards, even after this market downfall, and I'm telling you from experience, from actual portfolio returns, the returns are much more than 12%, worst case scenario, more than 15% in most of the cases. Why? because they were investing every month for 5 years. So even after 5 years, if the market falls, your returns will be way more than inflation in a well-researched portfolio. That's what I'm telling you from experience. I'm not giving you any guarantee or assurance. I'm saying if it's a well-researched portfolio and you're investing for 5 years every month, even if the market falls in the 5th year, when the 5th year is getting over, even then your returns will be more than inflation. Right? So always compare returns with benchmark and category. Standalone performance has no value. One last question. मेरे पास एक क्वेश्चन बहुत आते हैं. I get this questions lot of times in my LinkedIn index, LinkedIn inbox, or my comments or my emails and everywhere, that I am investing since last 5 years, 6 years, 7 years. Returns in my mutual fund portfolio is 11%. Is it good or bad? You tell me what's the answer. Is it good or bad? Returns in a mutual fund portfolio is 10%, 9%, 11%, whatever the number is. Let's say 10% or last 6 years. Is it good or bad? Tell me, what's the answer? क्या बोलूं मैं उनको? What should I answer them? It's a bad return or good return? Compare to index, compare to benchmark, compare to peers. Yes, again, some people are saying bad. How is it bad or good? Depends on, first of all, the question is, I ask them is, firstly, I don't, advise in any customized manner. So I say that I cannot do that because of my SEBI regulations. But even if I have to, the first question you should ask them is that, tell me the schemes you're investing into. Give me your portfolio of last 6 years. You are investing in large cap, mid cap, small cap, or hybrid, or wherever you investing. Then we will be able to see whether you have made good returns or not. We have to compare with peers and benchmark. How can I say just by isolation, एक number दे दिया 12%, 10%, 9%, is it good or bad? Whether it is a scheme or it is portfolio, the answer is compare to benchmark and category. Don't take a judgment call कि अच्छा है कि बुरा है. Right? Next. I will not invest in a scheme which is existing in the market for less than 5 years. Again, I can be stringent. Why? Because firstly, it's my hard-earned money, right? It's important for me. Number two, I don't want, there are many schemes available in the market which are existing for more than 5 years. And I can judge the performance of that scheme over that period. A scheme which was launched 1 year, 2 year, 3 year back, maybe they did well because the market was well, or maybe it did bad because the market went down. So it will be biased at my end to judge the performance of a scheme which is existing for less than 5 years. So I do not look at schemes which are existing in the market for less than 5 years, which takes out all the NFOs. But hold on, NFO, I will discuss in more detail on day 3. So if you have any questions on NFO, hold on right now. Right? Next, let me ask you a question. Look at this table. There's a scheme which had an NAV of 100 rupees. Sorry, NAV of 100 rupees in the year 2000. In the year 2020, after 20 years, the NAV of the scheme becomes 2,739 rupees. This is a return of 18% compounded annually. Listen to the question completely. All the other parameters of the scheme, whatever you need to look at, everything has been taken care of and they are good. All the other parameters of the scheme are good. Now, when you look at the returns, last 20 years, 18% compounded annually. Will you invest in the scheme? Yes or no? Tell me in the chat box. Yes or no? Yes, no, all kinds of answers are coming. A lot of people are saying yes. Everyone, please participate. Please participate. Yes or no? Compare with peers, compare check last 5 year performance. Okay. A lot of you said yes. Okay. Let me give you some more information and I'll ask you the same question again. This scheme in first 10 years gave returns of 27% compounded annually. In the latest 10 years has given a return of 9.7% compounded annually. Those who were saying yes, now tell me, will you invest in this scheme? No, Nitin, जरूरी नहीं है size scheme की बड़ी है. I said we have already taken care of other parameters. So size का हमने take care कर लिया. Now will you invest in this scheme? Last 10 years returns is 9.7% and first 10 years is 27%. The point is first 10 year returns were so good that even 20 year returns are looking very good. First few years returns were so strong that it has impacted 20-year returns also, right? So let me give you one example. Yes, if theoretical nahi hai, let me give you a practical example. First of all, the point is, do not look at returns since inception for funds launched more than 10 years back, because you might get influenced unnecessarily. Don't get impressed or influenced by schemes which were launched 12, 15, 18, 20, 25 years back, and their 20, 25-year returns is so amazing. Don't get influenced, because a lot of things have changed in last 20 years or 18 years or 10 years or 15 years in India. The fund manager is changing, the SEBI regulations are changing, the way businesses perform, the way stocks perform is changing. It's very dynamic. So what worked for the scheme in initial 10 years is not working for the scheme in latest 10 years, right? Let's look at an example. DSP Top 100 Equity Fund. First, look at the launch date, March 2003. It's been more than 19 years. It will complete 20 years very soon. Let's say 19 years old scheme. Look at right hand side, 18.22% compounded annual return since inception. It is phenomenal. Superstar scheme hai ye. 18.2% returns compounded annually for last 19 years on an average. Amazing, right? Let's go down. Look at this. Last 5-year returns, 6.48. Were clear? So they did so well in the first 7, 8, 10 years that even 19-year returns looks good, but the latest 5-year returns will put them somewhere in the lower category, lower ranking in their category. Right? So don't get influenced, don't get impressed by looking at very long-term returns. Yeah. Next, trailing returns. Look at 5-year returns. Why? In my opinion, it's like it's like a sweet spot. 5 years is not a very long term. It's not a very short term also. No, I don't want to judge a scheme in 1 year, 2 years, 3 years. I don't want to judge them for 10, 15, 12 years also, for the reason I just explained to you, right? Now you might say, why not 1 and 3? What's wrong in 1 and 3? And we can look at 5 also, but why not 1 and 3? So let's look at that reason. Now, before I move ahead, in this entire program, whatever I say, do this, don't do that, don't look at this, look at that, I will give you a why behind that. For every word, for every line. If I miss out on something, I want you to ask that question to me. Why did you do that? Why did you not do that? Right? Because if your why is clear about every step, your conviction level will be very high, and your returns, you are bound to make returns, because you know what you are doing and why you are doing it. Right? So this entire program ka jo foundation hai, the foundation of this program is why, the answer to every why. Right? Clear? All right. So let's look at this. This is large cap category. Let's look at some schemes. This is ranked as per 1 year right now. So first rank out of 31 schemes, the second rank, the third rank, and so on. Right? So look at the scheme, IDBI India Top 100 scheme. It is ranked 5. Now look at the returns are negative in last 1 year, but the scheme is good. Why? Scheme is good from last 1 year perspective. The rank is 5 out of 31. Market is down, so every scheme is down. They're not performing, but still it is giving negative returns, but it is at a rank number 5 out of 31. Right? The last 3 ranks are, year rank is also very good, 2 out of 29. But look at last 5-year rank, 16 out of 28. This is what is important for me, because as per my experience and observation and learning, it is possible to get lucky for 1 year, even for 2 or maybe 3 years. It is not possible or almost impossible to get lucky for a fund manager for 5 years. If a scheme is giving a performance in 5 years, it is based on research and skills. 1 year can be luck, 2 year can be luck, even 3 years can be luck, because 1 year performance can maybe impact up to 3 years. But 5-year performance is bound to be based on research and skill. And I want to invest my hard-earned money on research and skill, not luck. Clear? I hope this is clear. Right? That's why do not look at 1 and 3, because last 1 year return can make it biased. Last 1 year returns of market is not good. So maybe the scheme has not performed. Maybe it has got more beaten up compared to peers. But in the long term, 5 years, they have done well because they have more fundamentally sound companies in their portfolio. So I'm looking at 5 years because I want to base my investments on research and skill, not on luck and some destiny. Right? Next, one question to all of you. Let's say you are investing in stocks, 5, 7, 10 stocks portfolio, or you're investing in mutual funds, and mutual fund has got 50, 60, 70, 80 stocks in a scheme, and you're investing in 3, 4 schemes. So you're investing in, let's say, 200, 300 stocks on an average, right? So when you invest in stocks, the volatility or fluctuation is very high, right? The stocks move up and down very high because the number of stocks is very small. When you invest in a set of mutual fund schemes, it is so heavy. The number of stocks are so many that the volatility is less. I mean, they also move up and down. They also fluctuate when the market goes up and down, but not as much as a mutual fund, as a stock portfolio. The stock portfolio will go up and down like this. The mutual fund portfolio will go up and down like this. So the fluctuation will be less, right? Now, I want to understand just from your perspective, is that the same what you think? For example, the question is, when you choose mutual funds over stocks, let's say you want to invest in mutual funds, not stocks. You're saying I prefer mutual funds. Do you expect low volatility? Do you expect low fluctuation? Yes or no? I'm not saying investing in stocks is bad or good. I'm just asking you a very basic general question that when you're investing in mutual funds, you expect the volatility to be low compared to stocks. Otherwise, the purpose of investing in mutual funds gets defeated, right? So answer is yes, right? Just keep this answer in the back of your mind because this will, come up later. So when you choose mutual funds over stocks, you expect the volatility to be low. You expect the fluctuation to be low compared to investing in a set of small number of stocks, right? Now, comparing past performance of a stock in a mutual fund scheme is very different. Example, when I look at stocks, I can look at a company's fundamental and take a call. For example, I've invested in a stock ABC at rupees 100 and the stock price went down to 70, right? I can do my research and say, okay, fine, this stock is fundamentally still sound. It has gone down because of market sentiments or because of some temporary issue in the company or the industry or the competition. But fundamentally, this company is still strong. So I will buy more at 70 so that I can reap the benefits in the long term, right? I can do that in a stock, in a single stock. Now, when it comes to mutual funds, there is nothing called average fundamentals of 40, 50, 60 stocks. There is no such matrix which defines that this set of 60, 70 stocks has this kind of average fundamentals. You don't have any matrix to or any measurement to do that, right? So for this reason, also apart from general expectation, for this reason also, I want the fluctuation in a mutual fund scheme to be less compared to a single stock or maybe a set of 5, 10 stocks, because in stocks I can take an individual call on stocks. In a mutual fund scheme, from an investor point of view, I don't want to take a call on 50, 60, 70 stocks together, right? Number 2 point, a lot of investors say that I will go and do research on those 60, 70 stocks also which are there in the scheme. See, the point is, you are investing in mutual funds because you want to delegate the work of research. If you are the one who wants to do the research on those 60, 70 stocks, then what's the point of delegating the work and paying them that expense ratio and still devoting your time to do the research? If you are really good at stock investing, which you can be, why not invest directly in stocks and make more money? If you believe you can do that. You are investing in mutual fund because you want to delegate your work. You want to utilize your time to maybe grow in your other areas in your career, in your business or job, right? And of course, you already learned about turnover ratio. So every month, the scheme is selling few stocks and entering into new stocks. Every month, the composition is changing. How much will you research? This is just one scheme. You have got a few schemes in your portfolio. How much research can you do? It's not practically possible, right? So I want the fluctuation to be low in a mutual fund scheme compared to a stocks portfolio. That is a very natural expectation any investor will have, right? Now, let's come to rolling returns. Question is, how to calculate 1 year rolling returns of last 5 years? Sounds very confusing. Let's take an example. Let's say the investor started investing in a scheme on 24th of June 2017 and he invested for 1 year till 24 June 2018, and he got a return of X%. Let me take some names in the batch. Let's say Tarun started investing on 24 June 2017 till 24 June 2018, and he made X% returns, right? Let's say another participant in the group started investing in the same scheme. Sanjeev started investing, and he invested on 25th of June till 25th of June 2018. The returns are very close to that of Tarun, but they are a little different for sure, because the NAV was different on these dates, right? So his returns are, let's say, Y%, right? Now let's say another participant, Nitin, started investing in the same scheme on 26th June 2017 till 26th June 2018, and his returns are Z%, right? And so on. If you keep on carrying on this, one date, one by one. On 24th June 2021, Praful invested in the same scheme till 24th June 2022, which is today, and the returns are XYZ%, right? This is how the investments are going. Different people investing on every day for only 1 year, right? The first question to all of you: how many data points are there? X plus X, Y, Z, 1, 2, 3, 4, 5, 6, 7, 8, X, Y, Z. How many data points are there in total? Look carefully and tell me in the chat box. How many data points do we have total? Number batao mujhe na. Tell me the number. Look carefully. 5 into 365. Okay. Any other answer? 5 into 365. 250. Total 250. Okay. Any other answer? Everyone think. Abhi tak right answer nahi aaya. We don't have the right answer till now. Think. Every day for 1 year, starting 24 June 2017, and the last data point is 24 June 2021. Total, how many data points are there? 250 into 5, 4 into 365. Praful got the answer almost right. Vivek got the answer right, precisely. So answer is around 1000 data points. Why? Firstly, there are 4 years. Why? We start on 24 June 2017, the first data point. The last data point is 24 June 2021. This is 4 years. You cannot take data after that. 25th June 2021 se leke 25th June 2022. That is tomorrow. I can't take that data point, right? So this is 4 years. And in 1 year, approximately 250 trading days are there. Exclude Saturday, Sundays and national holidays. So there are total 1000 data points which we have got. Right? Now this is called 1 year rolling return. Rolling matlab roll ho raha hai. Every day they are rolling. They are moving 1 day ahead. Roll. It's like a drum rolling, right? So 1 year rolling return of last 5 years. Why is it 5 years? Because this date is 5 years back. 24 June 2017 till 24 June 2022. This is 5 year period. I have taken 1 year rolling return. That means every data point is of 1 year return. 24 June 2017 to 18, then 25th June 2017 to 2018, and so on. This is how you calculate 1 year rolling return for last 5 years. Now, you don't have to calculate. This is readily, easily, automatically available on websites. I'll come to that. Now, step number 1, shortlist top quartile schemes using trailing returns of 5 years. Again, sounds very complex. Let me simplify. What is top quartile? Top quartile means top quarter. Top, not that quarter. Top quartile, quarter means top 25%. Top 25% of the schemes in that category. That's what you take as number 1 step. Let's go to advisor coach. Let me tell you step number 1. Hold on. Okay, I go to MF research. I go to MF mutual fund trailing returns. Right? I select any one category I want to explore. Let's say I go to, again, equity mid cap. I want to look at 5 year trailing returns. Submit. Now, top quarter means top 25%. Now, first to find out top 25%, I should know how many schemes are there, right? Let's go down to the table. Look at this. It gives you the number 27. Total 27 schemes are there. Now, what is top 25% of 27? Tell me in the chat box. What is top 25% of 27? Approximately 7. Just divide 27 by 4. It is approximately almost 8, but closer to 8. So we can take 7, right? So top 7 schemes you will take, or you can even take top 8 if you want to, but top 7 schemes is enough. 7 into 4 is 28. So 7 schemes you will take. No, not 8, sorry. It should be 7 or 6. 7 is enough. So top 7 schemes is what we have to take, for example. Now, this is step number 1. Shortlist top quartile schemes using trailing returns of 5 years. So we have selected 5 years. Top 7 schemes is Quant, Axis, PGIM, Nippon, Edelweiss, Kotak, and Invest. Done? Clear? Next step. Compare these schemes using 1 year rolling return over last 5 years. Now let's do this exercise. Let me open another window. Again, go to Advisor Coach. Now look carefully where I'm going. Again, take the cursor to same MFEP research, and I'm going to rolling return versus category. Look at this app option, orange. Clicking on this. Now again, look at the data I'm entering very carefully. Equity mid cap is what we were looking at, right? What should be the start date? 5 years back. That is 24th June 2017. 5 years back. What should I enter here? Rolling return period. Tell me in the chat box. What should I enter here? What should I enter in the rolling return? No, not 5. No, not 4. No, 1. I have to calculate 1 year rolling return of last 5 years. I have selected this 5 year back date, but I want to calculate 1 year rolling return. 1 year mein roll ho rahe hain, they are rolling. The drum is rolling for every 1 year, every date for 1 year data. Right now, enter the scheme names. Top 7 names. Quant, Axis, PGIM. Now, one very interesting point. As per SEBI law, every mutual fund company can have only one scheme in one category. They cannot have, Quant Midcap 1, Quant Midcap 2, Quant Midcap 3. No, Quant Mutual Fund is a mutual fund company's name, AMC's name. They can have only one midcap category scheme. Right? This was also a law which came a few years back. Before that, mutual fund companies used to have multiple schemes in one category, and that led to a lot of confusion. Now, within this, there are 2 options. DIR is what? Direct. Now, for the sake of this program, I will only take regular plans in calculation, assuming that you will invest in regular plan and make conservative returns. Nothing wrong in that. I am just to keep the comparison apple to apple across the board. I am taking the regular plan. You also take that so that there is no confusion in different figures and numbers, right? So यहाँ कुछ लिखा हुआ नहीं है means it is regular. This is DIR means direct. So I take the regular plan. Next fund name is Axis, PGIM, Nippon. So Axis, again I take regular. PGIM, again regular. Then Nippon. Forget this bonus part. This is regular. The last scheme एक और लेते हैं. Edelweiss. Sorry. Edelweiss, regular. Now you can enter only 5 schemes at a time. So that's okay. We'll run for this and 2 we can take later. Submit. Now look at this amazing website and the response they give. Now look at this beautiful chart. Take your cursor to any one point. Let's say this. Now this is telling me from 30th January 2018 till 30th January 2019, Axis Midcap gave a return of 2.19%. PGIM gave a return of minus 15.79%. Edelweiss for minus 18.5%, and so on. Now, as I move, the returns keep on changing. Look at this. Look at this. Now, when you take 1 year rolling return of last 5 years, the worst will be negative for sure, because there at least will be one period in that 5-year period where the returns will be negative for sure, because it's not FD, it's not fixed deposit. It will go up every year. It can go down in any 1 year for sure in 5-year period, right? And so on, you keep on moving, right? Now look at this table below this. I am not concerned about average, not about median, not about maximum. I am concerned about this minimum. What is this minimum? This is the worst return you would have made in this scheme if you invested for 1 year. For example, if you invested in Axis Midcap Fund for any 1 year period in those 5 years, in last 5 years, your worst possible returns would be minus 12.37%. इससे बुरा नहीं हो सकता. This was the worst which could have happened to you, right? If you would have invested in PGIM India Midcap, the worst returns you would have made is minus 23.34% returns. This is the worst anyone could have made in this scheme. If your bad luck was really bad and you chose that particular day from which next 1 year returns were minus 23.34, right? And so on for other minus 26, minus 27, minus 40, 28. And this is equity mid cap, means this is category average 28.32, but that's not important. Don't worry about that, right? So this is also called minimum drawdown. This is also called the worst case scenario any scheme can have in a 1 year period, right? This is what I'm looking for. Now, how to interpret that, how to do you use that in evaluation, that will happen tomorrow when we do it practically. Right now, just understand step by step. Now, once we have done that, look at minimum returns generated. I have already shared this in rolling return. Next, now look at other factors. For example, turnover ratio, expense ratio, size, and number of stocks, and fund manager. Fund manager point I will cover tomorrow, and then we will start covering the start looking at exercise of shortlisting schemes. Right now, if you notice, this rolling return is a very stringent measure of determining the consistency of a scheme. Every day we are checking, what is the worst you could have done. So this is like looking at the fluctuation of a scheme. The lower the fluctuation, the better it is. I'll prefer a scheme which has got a minus 13% returns as worst case compared to a scheme which has got minus 28% as the worst. Because that fund manager is being very aggressive. Itna fluctuation, if so much fluctuation is happening in a mutual fund scheme, I'll prefer to maybe invest in direct stocks. Getting my point? So this is where the fluctuation point comes in. So I'll prefer to invest in a scheme which has got minimum rolling returns as the best possible scenario in the category. Right? Now, learning outcome from day one. Before we go to the quiz and I go to the Q&A, just hold on, listen to this, and please everyone take the quiz. Don't go away right now. I'm giving you the assignment also, so hold on. Don't leave the session right now. So we learned about SEBI categorization. We saw first 100 stocks, biggest companies of India are called large cap. Next 150 are called mid cap, and the remaining 250 onwards, thousands of companies are called small cap. Right? Parameters to shortlist mutual fund schemes. Turnover ratio, lower the better. Expense ratio, lower the better. Size of the fund, I gave you a range. Number of stocks, lower the better. Past performance, we looked at trailing return and rolling returns. This is what we covered in today's session. Before I go to Q&A, let me tell you the assignment for you. You have to check the 6 parameters of your existing schemes. Those who are investing in mutual funds right now, take out your portfolio, create a simple Excel sheet, enter all those 6 parameters. What are the 6 parameters? Let me open the example with you. Sorry, this is not the one. I'll share this in the Excel sheet, in the email, which I'll share with the recording, but that will come by tomorrow morning. You just can take a picture of this this slide. You don't have to create this formatting and all. Just simply create a simple Excel sheet. We covered turnover ratio. We covered expense ratio. We looked at fund size, number of stocks, trailing return, and minimum return. You have to enter this data for your own schemes and share that in the WhatsApp group. That's your assignment for next 1 day before you come to day 2. And please do the assignments. Please don't make this program a pravachan or a satsang. You don't want to go to some spiritual class or some motivation class and get motivated and get happy and come back and feel good about it. Doesn't make any difference to your portfolio. If you really want to make a difference, please do the exercise, because if you don't do day 1 assignment, you will be lazy to do day 2 and you will be lazy to do day 3. And the result will be 0. You will be happy with the program. You will praise me and you will say all good things, but nothing will happen in your portfolio. So please take actions, right? Those who are not investing, pick any 3 schemes of your choice and do this exercise. Clear? This is clear? Okay. Before I take questions, let's take the quiz, because we are very close to the time, 11 p.m. Firstly, the session time for tomorrow is same, 8:30 p.m. to 11 p.m. Right? The quiz, let me tell you the rules. Listen carefully, and everyone please take the quiz. Again, I've repeated multiple times. This is for your learning. This is a part of the payment you have made. Paise diye aapne iske. Please take the quiz. This is for your learning. Don't leave. It's not just for the sake of winning the quiz and winning the cash prize. Now, there are 12 questions. All are multiple choice. You get 1 marks for the right answer. You get -1 marks for the wrong answer. There is negative marking. Every question has got an option called don't know. If you are not sure, click on don't know and then move ahead. because that will save you from negative marking. If you answer right, you get +1. If you click on don't know, you get 0. If you click on something else which is not right, you get -1 penalty. Right? Now, second point, every question is mandatory to answer. You can't click on submit button if you have left any question blank. So either you mark the right answer or you mark don't know and move ahead, because don't know is not attracting any negative marking, so you can be safe. Right? But you have to click on every question, some answer you have to give, either the right one which you think is right or don't know. Right? Next point, when you click on the link which I'll give you, it will ask you for your email ID. Please, I repeat again, please enter the same email ID which you have used to register for this program. Now, some of you might be wondering, मैंने कौन सा ID register किया था? Which ID did I register? You have got a lot of emails from us today regarding this program, Zoom link and this and that. That is your registered email ID. If you enter some other email ID, the backend system will not be able to calculate your scores. And in a hurry, don't make silly mistakes. Don't make spelling mistakes in your email ID. Please enter very carefully. Right? And one last point, once you submit the quiz, it will give you a tab called view score. You can click on that view score and look at what is the score you have got, what are the right answers, what are the wrong answers. I mean, for the wrong answers, you will get the right answers there itself. Because once you close that tab, there is no way to check the right answers. I'm not going to share the answers in the email or anywhere else. Clear? 12 questions, I'll give you 6 minutes. 12 questions, 6 minutes, 1 mark for right answer, -1 for wrong answer, 0 for marking don't know. Any questions on the quiz? You can ask me, else I'll share the link. Any questions on the quiz? All set? Clear? Okay, all right. I'm sharing the link in the Zoom chat. Look at your Zoom chat. I've shared the link. I have not started the timer right now, so relax. Click on the link, enter your email ID, and then start answering the questions. And the same email ID which you used to register for the program. Timer start nahi hua hai. I have not started the timer. Please enter the correct email ID. Your time starts now. 6 minutes to go. Rajesh, link has been given in the Zoom chat where you have just entered this point. I can't find the link. Uske just upper link hai, just above that. Share the link again. I've shared the link in the chat also, in the WhatsApp group also. Check your WhatsApp group also. Half half time over, 3 minutes to go. Two minutes to go. When you submit, there's an option called view score. That's where you get to see your score and the right answers. 1 minute to go. Please start finishing up. I will deactivate the link as the timer goes off and your score will be 0. So please submit within time. I will deactivate the link. Submit. You will not be able to submit after that. 30 seconds to go. Fifteen seconds. 5 seconds. Please submit now. I'm deactivating the link. Time up. I'm deactivating the link in front of you. All right. So first of all, whatever scores you have got, that is without negative marking because Google Form does not have that facility. So if you have got a score of 10 out of 12 and 2 questions are wrong, your final score is 10 minus 2, 8 out of 12. So tomorrow when you don't see your name in the WhatsApp group in the top 2-3 people, don't get surprised because the final score will be after the negative marking. That's something we'll do at the back end. Right. SBI Tech Fund has got 22% allocation in Infosys. Ashwin, as I already shared while talking about that principal amount is 10%, but that company did much better than other companies in the scheme. That's why the allocation is that's shown there is as per the current market value of the scheme. That's why it can go up to 10%, 20%, 25%, whatever it is. But the principal amount cannot be more than 10%. All right. Now let me, those who want to leave can leave. I'll take another 4 or 5 minutes and answer some questions in the Q&A box. I might not be able to answer every question, but I'll answer as many as I can. Difference between absolute returns and annualized returns. Ankur, please go on Google and check. I don't want to spend much time because I have to do some illustration, but this is a very, very simple question. You'll get the answer on Google. Can I find performance of a fund for a specific period of time? Let's say 2015 to 2020. So Rajesh, you can do that, but it's not readily available. You can check the NAV of the scheme, maybe go to scheme company's website and there's maybe they'll have some historical data. You have to do it manually. But that doesn't matter that the scheme performance has gone down in the last 1 year because see, that's not the point. Every scheme is in the same boat. When you're looking at 5 years of one scheme, you're looking at same 5 years for the second scheme also. So they're all in the same category, same boat, and we have to see how much they have performed in last 5 years. No matter what was in last 1 year, 2 year, 3 year, doesn't matter, right? As per recommendation, large cap AUM greater than 17K is a red flag. Is it wise to exit such scheme? Yeah, that's what I'll recommend, Sachin, but don't take a call right now. This program will uncover in next 2 days, and then you will know how to do and what to do. Recordings you will get by tomorrow morning 9 a.m. in your email. Recordings of today's session will be delivered by 9 a.m. latest by tomorrow morning, and you will find it in your inbox. When you wake up in the morning tomorrow, you will find it latest by 9. Do direct plans reinvest the dividend? If yes, does the number of units increase in portfolio? Vivek, I think you asked the same question. I answered that. Just watch the recordings again, you will get that. It does not increase the units, number of units. No. NAV value बढ़ गई ना उसकी. You get more money in the fund, so the value of the NAV goes up. Units, no one will give you free units. Do you have an Excel tool which allows you to calculate all the criteria you stated and use, and depending upon the data tells you to buy or not? Suraj, that's what you have joined the program for. This is just day 1. Day 2 complete is left. Day 3 is left. An entire week I'll answer your questions in WhatsApp group. Then there is Q&A next week. So hold on. What you are asking for, you will get everything by end of day 3. Difference between hybrid and multi-asset. Multi-asset, I'm not sure. Multi-asset is, I think, gold and equity and debt. That's called multi-asset. Hybrid will have only equity and debt. Multi-asset can have also gold and silver and other assets. I think there's a difference between the two. When and how to compare benchmark, Pramod, don't worry. We'll come to creating the portfolio that will cover this dilemma also. Why is HDFC Bank there in small cap fund of Nippon? I didn't get your question, Ashwin. Nippon can invest in any company, no? Why can't they invest in HDFC Bank? I start a mutual fund company tomorrow, ABC mutual fund house. I can start a scheme and invest in any scheme. You know, Kotak mutual fund cannot invest in HDFC Bank, or HDFC mutual fund cannot invest in Kotak Bank. Maybe I didn't get your question. You can please rephrase. How is quant performing exceptionally? How to kisi ko nahi pata, Anurag, but our agenda is to shortlist schemes for us, and we'll see how do we do that tomorrow. Can tax exemption be claimed for investment in any type of mutual funds? That's for ELSS. We'll cover ELSS on day 3, Suraj. Debt fund is like, debt is what FD ke jaisa ho gaya. Debt fund is not as safe as FD, but debt fund is like low returns and low risk. That's a debt fund. But we are covering only equity funds in this program. Okay, that's a question, Vivek. SDFC is large cap. How can it be in mid cap, small cap scheme? So this question will be answered tomorrow. You'll get this good question. You'll get this answer tomorrow. NAV hota hai, it means number of units predetermined rehti hai. Once all the schemes are sold, it becomes a closed-ended scheme. No, they can generate as many units they want to. Closed-ended schemes are different, open-ended are different. If we are investing in any direct plan, will it matter during redemption? No, redemption ka regular plan or direct plans, there is no connection between the two. Is expense ratio informed in advance, or are we informed on the historical data? We already checked, Vivek, we were looking at expense ratio of schemes, right? So that you know what is the expense ratio of a scheme when you're investing today. Yeah, it keeps on changing every month, but that change is very small, 0.1, 0.15, 0.12, 0.2% every month up and down. So that's insignificant. Does mutual fund has to get prior approval from SEBI or MFEP to change expense ratio? I think I answered this question. They have to, change it as per the regulations and whatever the compliance is. Invested amount in UTI mutual fund, do we have to check portfolio regularly, or fund house will advise to switch or sell? No, Pramod, fund house will not tell you कि मेरे scheme से बाहर निकल जाओ, पैसे ले जाओ. No fund house will come and tell you that go and sell my scheme. You have to either hire an advisor, or you should know when to sell and buy. And that's why you have joined this program. So you'll get that answer in this program. Transfer of funds from equity fund to debt fund can be done immediately in case of falling market, suddenly as happened in 2020. Yes, you can do that, but no one will tell you in advance that this is falling or this will fall more or not fall. So I mean, I'll cover that briefly in terms of you should not time the market, and no one knows when the market will fall, when the market will revive. So there's no point of shifting from debt to equity and equity to debt just to play around with the market and get more returns. That doesn't work. I'll cover this, but yeah, broadly this is the answer. All right, I think I have answered most of the questions. Anything which is left, you can ask me tomorrow onwards, morning onwards in the WhatsApp group. Please don't flood the group right now. It's too late right now, 11:15 p.m. So I'll answer the questions tomorrow onwards. You can start typing your questions in the WhatsApp group after that, right? All right. Okay, I hope this session was useful, today's session. I hope you got value. And next 2 days is much, I mean, day 2 is much more important than day 1. Day 3 is even more important than day 2. Yeah, so it's like you going up the ladder every day. So make sure you're attending live. If you miss something, make sure you watch the recording as soon as possible. And then you come to the next session, right? All right, everyone. See you tomorrow, same time, 8:30 p.m. I hope you got value out of today's session and you got to learn new things. And we have just begun. A lot more to come in next couple of days. Yep. Thank you so much. Thank you, everyone. Good night. Thank you. Thank you. Good night.